It's me. Y'all on level 1, I'm level 3. Pounding on the table for my team. Every night I flex, I'm making big moves. That's a big move. Big money, big moves.
JT, what's going on, man?
Hey Rahul, you were on Spaces all morning, dude. Why don't you take some rest?
Dude, huh?
Why don't you take some rest?
Dude, I gotta speak the markets, man. This is what we live for. I see we have Jeremy Lin. Jeremy Lin, what's going on? I did have an opening question. Hold on. Eric, what's up, Eric? Jay Lin, how you doing?
Good, man. How are we doing yourself?
Good, good. I'm just gonna throw this out there. What the hell is going on? The Fed Bullard comes out today. He goes complete 180, which I'm not complaining about, but I don't know if you guys read the comments about him letting the balance sheet run off and not expecting a rate hike till March, and pretty much, I think, the best case scenario you would want as a growth investor. But then you see this headline in the morning. I don't know if you guys read the most SaaS or tech stocks. I need to go double check that while I ask the question. But I think it was the most growth selling in hedge funds in a decade. I saw a couple headlines, a couple of FinTwitter accounts posted that from a news source. And then you saw some growth stocks pop intraday today after a huge flush again in the morning, which was nice to see. But again, I don't know how much of this buying is valid or real. What are you guys' thoughts on that?
Yeah, I mean, yesterday we were just talking about that, right, Rahul? Most of what we heard from the Fed yesterday was December, things might change. And again, we have the NFP numbers coming out tomorrow. We will have a lot of talk about inflation and whatever Bullard is saying. I think it's a forethought about on what Fed is going to talk about later this month of January. These are all these conflicting comments that are coming out. I at this moment, like after that 180 that JPOW did back in I think it was in November, right?
Yeah, it
From
was
back then,
November.
yeah, like I completely think, right, take some things off the Fed minutes that come out, play the direction that day, but the first move is always the fake move, and just forget about it. At this point, I think the Fed does not know what it's doing. I mean, it's not like I know what I'm doing, but you get what I mean, right? I'm just trying to play the
No, they
momentum.
they don't have, I guess, control on anything going on, like in terms of inflation, the counter ripple effect that the credit would face if they were to speed up rates. I honestly think they're in a really tough. It's a historic spot, I would say. I mean, you're not only trying to solve a pandemic-induced liquidity problem, you're solving a thing like said yesterday, a four-decade liquidity injection, accommodating for the most part outside of what Paul Walker did in 1970s. But you're talking about you're backtracking a good amount, at least till 2009. I mean, that's very clear.
Yeah, I mean, definitely that. There's a lot of trouble for them, and now like we are seeing China easing, and Chinese stocks are going up too. That's that, maybe that's how China will grow into 2022, 2023 maybe. Rest of the world is doing QT and they do QE, and most of the FII is going to roll their money into China market. uh, who knows, right? And that's kind of a security threat per se, right? In terms of how the nation operates. So yeah, I mean, the Fed is at a very tough spot. They're not going to rattle the market per se, but from what I saw yesterday and what we were talking yesterday, this was a perfect example as to what happened, right? If you went over FinTwit last night, everybody was calling, this is like there's more bottom, this is all going down, and we are going to see 4600 on SPX. There's no support at all here, and look what happened overnight. Absolutely nothing per se, right? Uh, so some things to keep on watch, and we were pounding on Facebook yesterday. You were talking about SC. D Dog had a big partnership again. So like there are opportunities in the market that we have to figure it out. But like as most of our traders, most of us do, we try to concentrate on a very select few stocks. And if when they are not moving, why even try to go search for something else is what I kind of do. So the first 3 days I didn't do much. Today Facebook ripped, I made money. So I'm just waiting for that opportunity, like just wait for when your stock moves, when a stock that you like moves and things like that, and then deploy the money for that opportunity is what where I'm going at with this market right now.
Yeah, for sure. I think that's a good answer in terms of not forcing a trade. I think I always like saying, I've heard this a lot, don't trade the market you wish to be in, trade the market you are in. So make sure you understand what factors are driving the market at the given time, right? What happened in 2020, 2021, it's done, it's gone. It's just history. I mean, past will only give certain precedents, but there's a different regime, different macro data happening day to day, and I mean, we're dealing with unprecedented times. But Jeremy Lin, what's going on? Eric, how's it going? Jeremy, do you want to chime in?
Yeah, sure thing. So I think, KT is pretty spot on with what we saw today. One thing for me that's pretty important that I'm not going to base a decision off it until I actually see it materialize. But yesterday, the Fed notes, had a mention of starting QT before the rate hikes were done. So there was a line in those, Fed minutes that stated the Fed would consider starting QT and maybe rolling off some assets on their balance sheet after the first rate hike, which now is most likely to be expected in March. Kind of a little bit of a reversal on that today, back to pre-consensus that I think most of these sell side firms were expecting, was that if there were to be any sort of QT or selling or rolling off assets off their balance sheet, kind of to bring their balance sheet to more of a neutralized equilibrium. They would start this after Q4 or maybe in the next summer after the majority of the rate hikes have already been enacted. So I think, personally, I mentioned this yesterday, but these institutions have large algorithmic trading mechanisms that will basically trade off of, sentiment and rhetoric in these proxies that we get from the Fed. And I think that was one line that might have, started some, rampant selling that potentially, as today, in some names looked a bit oversold, right? And until the Fed actually tells me that they're going to do QT, um, especially before any sort of rate hikes are enacted, I don't think I can, rule out equity investing, because, as we know, all equities are risk stocks, but some are, valued at a much more attractive multiple. And from what I saw today, underneath the surface, is that the companies that do have great earnings, cash flow positive, and traded at lower multiples compared to the indexes last year, sort of started to get some, buying pressure, and we were seeing some buys in some of these names. So, like, ones that stuck out to me were Facebook, PayPal, Baba. These all had quite strong days. They faded a little bit into the end of the session because I was watching the options flow, and there were some bearish bets that were coming in on Apple towards the end of
Were
the
you
day.
watching? Were you watching CrowdStrike? Yeah, Apple had good needs of puts. I don't know if you saw that sweeper puts at 170.
Yeah,
But
and
were you watching CrowdStrike as well? They had a nice bounce with that initiation of Wells.
to be honest with you, I wasn't really watching too many growth names today. I did see that they, performed pretty well. Am I gonna stand here and tell you that carnage is over in the growth names today, and this was a complete reversal? No, because some of these are still trading at multiples that are unprecedented. Especially if we enter a
Yeah,
high yield environment. But I did like what I saw, as you said, in like some of these cyber names, and I saw a draft today really stood out to me because they had some PR that there's going to be legal sports betting in New York starting Saturday. So, New York is one of the biggest untapped markets for sports betting, like just from a population density perspective and, per capita disposable income. Like, New York is a great target for like the sports betting industry. So I think that could be some extended revenue streams. And I was watching the flow there too. I was seeing some call spreads coming in for later January, all the way into March, from the floor, which, definitely kind of piqued my interest a little bit there. Also just seasonality. We got the Super Bowl right around the corner. So that's going to be one of the Kathy names that I do have on my list here if we were to see some continued strength. But yeah, Raul, I'm looking at CrowdStrike right now. It does look like it held up pretty well today. So
I think it was a Wells initiation that helped it, which there was nothing new in the report, but I guess a new report coming out. Yeah, I was just kind of curious if you were following that one as well. But yeah, no, appreciate that, Jalen. I think we have on, but I think he's doing something, so he'll speak once he has a second. Eric, what's going on, Eric?
What's up, guys?
How's it going?
I'm doing pretty good. Again,
You're
I'm
100% cash. You're in the best position right now.
yeah, man. I mean, but I hate it, right? Like, I want to be in there. I want to be swinging. I want to be chucking and shit. But you are, I think Sniper, you said this. Man, I don't have an edge right now. I'm really stuck in figuring out what I'm gonna do. So yeah, I think time. I think time is your asset, and I don't know. I'm seeing just so many people, try and like time this or bottom this or like
There's no
win
rush.
the
I was saying this
base.
yesterday. Just wait till earnings, or wait
Wait
till
till
at least the week of the 25th. What pointed out yesterday that
and
the amount of
everyone is like
volatility events.
staring. They're like staring at the day. Pull up a weekly.
Yeah,
This is a mess. This is
exactly.
not good. So I didn't have anything really that insightful or that intellectual to say. But yeah, I just think this is a no go zone. I think you can find ways to take your stabs. Honestly, I'm waiting to even like do real homework for the weekend. Really see how things look tomorrow. Um, but I don't know. I was seeing a lot of bullish, like, oh, we're rallying, it's all good, this is it, or hey, look
I
at
don't.
this,
Yeah,
maybe it's time.
there's no way you can call
You know,
anything because no
no
one
one,
here has seen a quantitative tightening cycle, really. To be
no,
honest,
bingo. No one's seen a
that's.
QT. No one's seen it. So this is right now where I don't want to call people rookies and vets, but you're going to find out who you're either a really long term investor or you really don't know what you're doing.
I mean, majority of those, or not majority, at least half. I called it the other day. FinTwit summarized was the tweet. Whoever claimed was long term from 2020 has already gone into cartoons, so that batch is gone. We don't have to deal with that, which is good. So hopefully the best of the best will survive. I think this is a good clown only for the market, but also FinTwit, to be honest.
Absolutely. Man, Sniper, you crushed it with Facebook today. I mean, I know you run a service, but what a call, because I was seeing that and that was the only thing where I had some stock envy. Honestly, I don't have anything really that much intellectually else to say, so I'm gonna get off as
Yeah,
speaker.
you
But
can stay on, Eric.
all right, I'll stay on.
Yeah,
Maybe
no
something
worries.
slides in.
Maybe
But
we
yeah,
can go to
that's
Luca. He can
yeah,
do a
show
daily
something
wrap. He
else.
does. He usually covers the market. So Luca, you want to just give a couple minute overview of what you saw today?
Yeah, I can do that. I can actually go through my notes that I went through for the briefing.
I'm just
apologize,
gonna
sir.
say one thing though. If randomly comes in, I'm gonna have to toss it to him because we might lose him. So, but until then, the mic's yours.
That's fine. Yeah, so I guess I'll start with the markets and kind of what I'm thinking, and then I'll round out with the briefing real quick. So I take a look at the markets today, and if I'm being honest, this whole week has just been choppy nastiness, and I don't find it fun at all. And I don't think anyone else does either. And I came into the week pretty excited. It was a new year. I was like amped. I was like, let's get it. Let's make this year awesome. And we just did not get the price action to support it. And I'm typically a swing trader. I like playing those symmetrical wedges, those ascending triangles, those descending triangles, and we just haven't been getting them. It's been really tough to find ones that break out with power. Because if they do break out, it's not really as powerful as they usually are either. So that's been tough. So I've pretty much shifted into chop mode here, intraday levels. Today I played NVIDIA pretty much all day. That's all I traded. And I literally traded 3 levels all day. That's all I did. And I made some money back. I actually went back to positive on the year. Yesterday was a tough day for me. But we came back, we bounced back, and that's what this game's about, learning every single day, taking a lesson from the market. But either way, going into really what we got today news-wise, we did get those jobless claims. So jobless claims coming in at 207,000 compared to the 195,000 estimate, and that's 7,000 actually higher than the previous week. And that also bumps up the 4-week trailing average to 204,500. So that's also something to pay attention to. So not like a terrible number, definitely not bad, but not really what the market wanted. You'd like to see it meet the estimate at least. So that's something to note there when it comes to jobless claims. And then also continuing claims actually rose by 36,000 to 1.75 million. So that's also something to note. No outrageous moves there whatsoever. Pretty much as expected, just a little above the expectations, really. Nothing crazy. And then we also got data on the trade imbalance and then U.S. factory orders. So according to Bloomberg, because that's where I got the data, so I'm just going to cite it directly from there. We did see the U.S. trade imbalance for goods and services that jumped to 80.2 billion in November. That is up from 67.2 billion in October, and that is also below the estimate, though, out of Dow Jones of 81.5 billion. So that was all right there. Definitely not amazing, but you do want to note here the previous high on that, the September record, was at 81.4 billion. So it neared that record. So that's definitely something to pay attention to. But I think it was mostly expected, obviously, by the estimates out of the market. And then finally, U.S. factory orders here. When it comes to factory orders in the United States, we got this data this morning out of the Commerce Department. In factory orders for November actually rose 1.6%, and that was ahead of the estimate of 1.5%. So that was solid. And they also revised the October data, now up to 1.2% growth there in factory orders compared to 1%. So that was some solid stuff on that front. Year over year, orders increased 12.9%. And I won't get into the nitty gritty of that data. If you do want the more nitty gritty when it comes to like shipments, inventory, the podcast is out, so you can check that out. And then going through analyst calls, we had RBC naming Amazon and Uber top picks. They were pretty much underlying or outlining their product cycle and the stories there throughout 2022, liking Amazon's capacity investments that will start to bear fruit, according to them, throughout the year, and Uber's mobility rebound and potential or potentially inflecting at the same time. So RBC liking what they were seeing there in Amazon and Uber for the year. Evercore ISI upgraded Lowe's to outperform from in line. That was an interesting call there. Pretty much the basis of their call on Lowe's was that pre-COVID, they were starting to turn around, and the changes they've made have now cemented themselves, and that the company is now well positioned throughout the year, and that it will be a solid compounder. It'll be interesting to see if all of that develops, but Evercore ISI upgraded Lowe's to outperform from in line today. We had JP Morgan reiterate Netflix is overweight, so a call on one of the big FANG names. If you are interested in those FANG names, as I like to call them, Goldman Sachs actually naming JP Morgan and Bank of America top picks for 2022. But simultaneously, we had Bank of America downgrading Goldman Sachs. So that was kind of funny. You had Goldman Sachs naming Bank of America a top pick for the year, and then Bank of America simultaneously downgrading Goldman Sachs. But Bank of America did downgrade Goldman Sachs, basically citing that they don't see much more upside and the moderating capital markets throughout the rest of the year. And then finally, when it comes to analyst calls, Bank of America did upgrade Coinbase to buy from neutral. So if you have been waiting on Coinbase to finally catch some upgrades, you're finally starting to get them. I know the analysts for quite a few months there weren't all too happy with Coinbase. They were hating on it quite a bit, but now it's starting to catch some upgrades, pretty much because of the amount it sold off. So possibly a name to take a look at, because I know that's taken a pretty large hit in recent weeks. UBS named Disney a top pick for 2022. And then finally, Wells Fargo initiated CrowdStrike as overweight. And this came alongside a lot of upgrades for cybersecurity names this morning. And then to round out the day, we had Datadog furthering a partnership or another partnership with the Amazon Web Services here. It's a global strategic partnership. And in essence, what this partnership is going to do is it is going to allow users to benefit from Datadog's full stack security across all layers of their cloud environment. And it's also going to enhance security signals. So that is something to note there. And then finally, I thought this was an interesting data point to pull out. When it comes to the NFT market, if you're interested in crypto and NFT markets, we got data out of Chain Analysis. And they noted that from the beginning of 2021 through to mid-December, the NFT market passed $40 billion or past that $40 billion mark. So if you are all about the validation of NFTs and you believe that NFTs are going to continue to be a major theme or a new industry almost, you could say, whatever you want to call it, a lot of those people are arguing that, hey, the NFT market passing this $40 billion point, nearly $41 billion of cryptocurrency being sent to two types of Ethereum smart contracts associated to NFT marketplaces. This is definitely, I think, a point of validation for them. There's quite a bit of capital moving through NFTs, you could say. So definitely a interesting, I would say, detail within the crypto markets as we go into 2022. And I don't think I've seen any slowdown in NFT hype throughout the past several weeks. So I figured I'd throw that in there. But that really was the day when it came to headlines and data. Those were some of the most important points that I found and figured I would speak about. So if you're interested in that, I'll actually pin the tweet right now. The podcast dropped at 1. It's a daily briefing. It's under 15 minutes. I do this every day. I go through the biggest headlines of the day, the biggest analyst calls. And that's kind of, it's just a really easy briefing, gets you through all that information real quick, and you kind of just have a primer on the day every day. And then on Fridays, we do weekly recaps where we go over the biggest points of the week. But yeah, that's kind of my focus. I continue to be focused on levels, intraday levels, and just playing those support resistance levels with shorter term options. If I can bag 5-10% on a few minute trade and make a few of those trades a day, I'm happy. I'm still sitting on cash when it comes to the long term stuff. I have quite a bit of cash. I hate holding cash, like Eric said. It's no fun, but look, you just have to wait for the opportunities to come to you, as the multiple speakers have mentioned. And once the opportunities are here, I'll be putting more capital to work. But right now, very in and out, very quick, and taking the opportunities as they come.
Awesome. Thanks for sharing that, Luca. And definitely check out Luca's daily wraps. A nice, quick way to keep up with what's going on and digest all the information. What's going on, Parrot? I don't know if are you here yet? I guess not. Parrot, how's it going, man?
Good, Roll. How you doing, man?
Doing well. Did you guys, is something happening with DWAC tomorrow or fun with our ticker? I keep seeing it on my feed.
I don't know. It popped today, I think. I heard.
Someone
Trump said
he
he is going to launch it in Fed.
So something happening tomorrow though, or no?
Not tomorrow.
Okay, this is just a headline. Okay.
Yeah, it's a headline, and it just it's just a speculative name out there.
Yeah, got it. Yeah, if anyone has questions, I'm happy to start taking some. The one thing I would avoid is, while I love hearing from people coming up and giving their inputs, I'd rather stick to questions just because I think we have a full panel of speakers, and not to say someone is smarter than someone in the audience. It's awesome to hear from everyone. But yesterday I ran for like 4 hours, and if I had to pick, I'd rather focus on questions so I can, we can try to engage in those conversations a bit further. All right, so I think we have a question coming in. Art Vandalay.
It takes quite a bit of time to actually come on.
I think he's on though. Are you on?
Oh, yes. Sorry, I'm on. I actually have a question for Parrot. I don't know if he hears me.
Go ahead.
I follow his Twitter feed and I appreciate his transparency, but I just have a question as to when. I know he doesn't. I don't think he uses stop. Sorry. Hello.
Yes. Hello.
Hi.
I have a question, please. What do you think about some stocks like the CB?
Oh,
Did you not hear someone else
yeah.
speaking?
Sorry, I was in the middle of a
I
question.
don't understand. Yeah, go ahead.
Sorry
Yes.
about that. Just to be quick, I just have a question for Parrot. And it seems to me, following his posts every day, that I don't really see any stop losses in place. I know a lot of people like to have stop losses if stock price drops below, let's say, a 30-week moving average, if there's a repeated decline and a spike volume. So I'm just wondering if he has any rules in place to liquidate any stocks that are not performing well. I know he's more of a long-term investor, which is a viable strategy, but it could also be very costly if there's no, I guess, disciplined rules in place. So I was wondering if you could speak to that.
Yeah, sure. Appreciate the question. Appreciate you following. Yeah, I don't typically use a lot of stop losses unless it's a really short-term trade, and I can't watch it very closely. I have some other things going on, so I'll use a stop loss. But typically, I'm watching posts enough to where I'll pull the trigger myself if I need to. If I need to. But like you said, most of my positions are long-term, either long-term positions or even my trades are usually long swings. I don't make a whole lot of short-term trades, so I don't use a lot of stop loss. What I'll typically do as far as, cutting losses, I mean, if my sentiment changes, if my personal sentiment changes, I'll cut a position. But I'm typically, usually I basically rank all my companies, all my positions on conviction. And if I find something I want that's a higher conviction than what's on my list, I'll sell something and buy it. So that's kind of how I handle it. Try to stay mostly invested. I'm mostly 90% invested, and about 10% I'll use for kind of trading, long-term trades and things like that. But that's basically how I handle it.
Appreciate it. Thanks.
Thank you. Thanks, Art, for the question. I'll check again. Are you there? Can you hear us? guess not. Parrot, any insights, any takeaways from this back and forth from yesterday and today with the Fed? I think we covered that a little bit. Well, I think you were listening, but any insights, feel free to chime in.
Yeah, I don't have a lot of insights from the Fed really. I didn't hear today's comments. I know he said something today, and the markets I think tanked again, didn't they, or went down a little after the conversation. But no, not really. I mean, today I was mostly impressed with PayPal. I actually called the today's bottom. I posted in a chat. I think you're in that chat, but and got lucky. Other than I didn't buy any because of the issues going on, so I couldn't sit in front of my computer today. But had about a 50% turnaround on the options that I do have on PayPal. But in general, it's held up pretty well compared to other stocks in that sector and really in my portfolio in general. So I like the way it looks right now. Other than that, just kind of watching today.
Do you have a preference on PayPal or Square? Just curious since you brought up PayPal.
Yeah, I've had a preference to Square this whole time. I really haven't owned PayPal. I've traded it a couple of times, including right now. I have a couple open options, but I do prefer Square currently, although the price hasn't been too kind the last couple of weeks. But to me, I don't know. It just seems like PayPal's always chasing Square. Square seems to be more innovative, kind of more on the cutting edge, pushing the envelope more. And PayPal kind of seems to be following. At least that's my perception. But I haven't really dug into PayPal honestly that closely. I've traded it a few times, and that's about it. So.
Yeah, fair enough. I think MM's finishing up a class, so he'll set it on pretty shortly. But in the meantime, again, if anyone has any questions, you can request it. Happy to take them. I guess next question I would have before someone comes. Go ahead, Eric. Were you gonna say something?
I wanted to talk about like the stop loss, just like that topic real quick. Parrot,
Go
I
ahead.
think you did a great job. And Parrot's like full transparent of being like a long-term investor, which I think that's something on the internet that we're not more open about that. Some of us really aren't, as long-term as we think we are. The problem with stop losses, just my 2 cents, you know, keep in mind that I think someone was saying it about how, there are these algorithms that are really more
Yeah,
advanced than
Jalen was
price
talking about it
action.
yesterday. Yeah.
Yeah. So I think that's something to just keep in mind when, you've got your stop loss set. Just, I think Duckman had like he's got like 10 or 12 quotes, and he says, know where the crowd's stop loss is or know where the algorithm stop loss is. So I don't like using stop losses either. I like kind of managing my risk and pulling it when I need to. That's just me. So I figured I'd just touch on that real quick.
Yeah, I guess a good general question. Does anyone, like, how do you guys manage your, I guess, risk, and do you guys use stop losses? Or I don't. I'm kind of on Parrot's boat as well. I personally don't, because I just don't want to deal with the situation of stopping out and having to rethink when to get back in. I'm pretty convicted when I start a position that it's something I want to get into. But I know KT employs a specific rule where he doesn't average down. He only averages up. So that's definitely interesting. What else I want to say? Also, another rule I have to follow for my job is 30-day hold. So for me to get stopped out and having to deal with that whole situation is just another headache as well from a compliance perspective. So, but what you could do is do covered calls. That's something I used to do when I was allowed to do options trading. I was allowed to only sell actually covered calls. That was the only type of option. But this new job I'm in, that's not even allowed. So.
Yeah, usually stop losses, especially with options, I never ever put stop losses. Like I'm usually looking at my position all the time. But with stock, uh, I, I tend to hold them for long term. So I like what this parrot said, right? Like until and unless my conviction has turned bearish, something happened to that stock, and they are deviating from their vision. And one day Elon Musk just leaves Tesla. Maybe I'll sell all my Tesla stock. Just say, that's how I play my stock. But with options, I never put my stop losses at all.
For me, I'm kind of in a similar boat. I think the one time I do tend to use a stop loss, it kind of depends on the product I'm trading, right? So if I'm trading like a large cap tech stock, then necessarily I'll have, my key pivots where I would consider, buying, selling, or getting out of the trade. But, let's say I'm trading like a D-SPAC or like some illiquid, like small cap stock, I usually do find it pretty helpful to use a stop loss because price action could be shifted just based upon like maybe a certain block trade So in those scenarios, I do tend to use them, but for the majority of my investing and trading, like especially with long-term investments, I don't necessarily use them.
Yeah, all my investments are long term usually, so that's kind of I guess I agree with that I guess style. Sure, me. Um, Mahesh Saha, did you have a question?
Yeah, so I know that a lot of the people on the panel today are largely investors. Like, I know probably hyper focuses on options, but I was wondering, like, so I pivoted into cash too, like about 2 weeks ago, and then started opening up a bunch of short positions, which I'm currently exposed to. But is there a reason against shorting? Like, I've generally noticed that a lot of people tend to not short, but is there any reason specifically why not? And in my experience, at least, the technicals for shorting work just as well as they do on the long side. And I don't know, I find it fairly similar when I'm shorting personally, but I would like to hear if there's a reason why you guys don't.
I've always heard not to go naked short in a position. It can just blow up account. I personally have never, I guess, tested that or even employed shorting stocks. It's just not something I'd like to deal with. And also, like I said, options rules that I have to comply with. But I know KT is trading at a pretty heavy scale in terms of the money he's managing and the options he's playing with. So, yes, KT, do you have any insights on that one?
So shorting, as I'm a primarily like this the big tech investor per se, and would I bet against Apple, Facebook, Microsoft, whatnot? Like I quite don't know. Like I I, I wouldn't maybe. So I never looked at things in that angle per se. Like when you're shorting, I'm also using another leveraged thing where I'm playing puts, right? So that's my way of uh, trading a long-term trend. Let's say, like if you look at Apple, Microsoft, Facebook, whatever, right? Like they have been growing all the while they like since they have started having EPS positive or whatever. And if you're saying like you hear this a lot, right? Like don't trade against the trend, follow the trend, things like that. If like let's say in this huge scale, like in this huge time frame, I have been long on Microsoft, Apple, Facebook, but in the short term of sense, I'm always like looking out for opportunities. Like if Microsoft, what happens if Microsoft dips 10%? Like I'm up 100% on my shares already, but like for 10% probably I can play some puts, but I don't usually go with shorting uh, uh, shares per se, and for me it's more or less like why even go with shares when I can leverage that fast dip using options flow? Because in a bull market like we are in right now for the last 10 years, you will always have staircase up and elevator downs. And when you have those elevator downs, options are the best way you can go and leverage movement in the price action. So that's just my take on it.
Jeremy, 1 second. We can continue this question. I think we have
Yeah.
for a short time frame, so I'd love to hear his thoughts on some things before we kind of continue this chatter. We'll continue that conversation for sure. But I guess one question I'd like for you to answer. I guess this is a loaded question, so it's like one big question. What do you think about Bullard's comments? How are you seeing that affect the fixed income side of things in terms of flows? And then also with hedge funds, that headline that came out that asked initially, I just pinged you as well. I think you posted on it, you said. So just kind of take it away.
Sure. Yeah. And, thanks for having me. Pleasure to be here with all you, and hope everyone's doing well. I know this week has been pretty choppy for a lot of people. So, keep your head up. We'll get through this one way or another. But ultimately, what Bullard is saying is kind of, it fits his character. He's been the perennial hawk for much of 2021. He's been cursed to saying we need to raise rates and we need to taper, and now he's a voting member in 2022, and that matters, right? So we had this sort of contrast. We had Daly come out, San Francisco Fed, try to play good cop, say, hey, we're not going to do this QT until later, right? We're going to maybe do this QT after some rate hikes, after we normalize the Fed funds rate, and she's not a voting member. The San Francisco Fed doesn't have a vote on FOMC until 2024. So her words don't carry as much weight as Bullard, because St. Louis Fed does have a vote in 2022. And so he came back and basically walked back everything she said. But what he said was 100% in line with the minutes that we heard yesterday, which jarred the market. right? So really what Bullard basically did was he walked back what Daly had put out there. And that's not too surprising. He's of that cut. The cut of his jib is such that he's more hawkish. He's more conservative about monetary policy. So this is sort of what we could have expected from him. And of course, as that hit, we saw the markets give back a lot of their gains because some of those gains were predicated on the notion that, hey, maybe they're kind of pivoting, right? Because the Fed floats trial balloons all the time. They want to see how the market reacts, how it digests them. They want to kind of test sentiment and how it changes, and whether or not they overshoot. And even though they do this kind of testing, they usually overshoot anyway. But this is sort of a process that the Fed does. So we got to kind of expect more because we're in uncharted territory. They've never successfully normalized their balance sheet. The Fed's not the only one either. The UK House of Lords did a study of central banks around the world, and they found that no central bank anywhere in the world had ever fully normalized post QE. That's an important thing to think about. No central bank has ever fully normalized their balance sheet, their policy post QE. There's a sort of propensity to go toward normalization, but not be able to quite reach it because there's more leverage in the system. There's more sensitivity to rates. There's more sensitivity to the abundance of liquidity or lack thereof. And therefore, it creates a different paradigm post QE. In fact, we've seen that paradigm play out in the United States for quite some time, just with lower lows and lower highs of Fed funds rate for the last 40 years or so. So I think that what we have from Bullard is he's reinforcing that, look, despite what a more dovish member that can't vote is saying, we're broadcasting the idea that we're continuing as planned. Now, obviously, we have another Fed meeting coming up in the back half of this month on January 26th. I believe we're going to have their policy decision, which probably won't bring any meaningful change, but we don't know. And also their Fed press conference where Powell's going to have this sort of Q&A, and we're going to see, kind of where he is, what he's talking about, if he's, pivoting backward or forward. It's also going to be important to pay attention to econometrics that come out. That's that macro data flow that comes out ahead of the Fed because they're watching things like that very closely. CPI, PPI, PCE, employment, all that kind of stuff. But ultimately, I think it's a bit bearish, just in the sense that many people are kind of pinning their hats and buying dips on the sense that Daly was saying, we're not gonna do what we said, and Bullard's saying, well, actually, we are, and I vote on this, and this is the path I want to take. Another thing that's an important takeaway when we went into yesterday, right, based on positioning and expectations, and just what I've heard from other experts and folks that I've talked to that I know personally, and really my own take. Nobody really expected the Fed to come out and say, yeah, not only are we going to do QT, but we're actually going to pull forward the schedule significantly, and we're going to kind of intersperse it with our tightening, with our hiking of rates. No one really saw that coming. Maybe some really hawkish people thought that might be a possibility. But remember, after the December meeting, what did Powell say? He didn't say that we were going to do QT. He said we talked about it. So that was the expectation. That's what the market believed. And so what they came out and said yesterday changed sentiment. It changes the probabilistic outcomes if indeed they do follow down this path. And it is pretty bearish for markets to have the Fed saying, look, not only are we turning off the spigot that fills the pool, right, QE, and the tightening that they're doing, we're actually going to drain liquidity from the market, which is them selling assets off their balance sheet. Now, you got to ask yourself, really, how's that going to work? How are they going to sell assets off their balance sheet when you have a situation with rising rates, where you have the government talking about taking on new debt to do things like Build Back Better? There's already a growing supply of debt. The Fed's been buying 40% of 10-year auctions. They've been one of the biggest buyers in the Treasury market, hands down. And when they buy Treasuries, the Fed actually pays back the interest on that debt to the Treasury. So they've also been monetizing debt. It's basically free debt. The government doesn't have to pay interest on it. It gets that back later. So that's another really important point, because the changing of the paradigm is significant. We're going from a situation where the Fed's fully monetizing to a situation where they're not only not monetizing, they're taking liquidity out and they're selling Treasuries and mortgage-backed securities off their balance sheet. So who's going to be the buyers? What does that do to the elasticity of the debt supply? How does that affect interest rates? How do those interest rates affect price discovery in riskier assets? And those are all the things that we need. Those are like interworking parts that we all need to be cognizant of as market participants, because they impact how it is that we may want to position to benefit from this or to try to mitigate risk. So it's going to be really important as to whether they actually follow this path, right? How many times have they said something and done something else? That's still a possibility. We could get the sort of classic perennial Powell pivot. We don't know if that's going to happen. So that's still a possibility, but you don't want to hang your hat on that. You don't want to say, I'm going to make the bet that Powell's going to do a 180, because you're basically just betting on a coin toss. You have no insight, or advanced knowledge of that, or at least I hope you don't. If you do, it's a whole other game. You're insider trading with the Fed, right? But in all seriousness, you got to be cognizant of risk, because every bull cycle has really kind of ended with the Fed overreaching. Even what we had going into COVID had something to do with the QT and the rate hikes and some of the tightening that happened ahead of that. And then, of course, you have the great financial crisis. The Fed was tightening policy as there was too much leverage in the system, set off a bomb of a lot of insolvency and a lot of leverage having to come off rather rapidly in a disorderly fashion. And then you have the dot-com bust. I mean, they were raising rates all the way into that. A lot of that leverage got eroded as well. And, when you raise rates, it doesn't just have impacts on treasuries. It's really the cost of funding and funding everything, funding a business, also funding a margin account. Cost of capital goes up, which means you're going to have to take less risk if you're employing leverage. And there's, from a market capitalization standpoint of the S&P, margin is not as high as its all-time high, but from just a sheer raw number, it has hit new all-time highs. But the leverage really isn't even in margin. If you really want to see the leverage, it's in how options are being used in this market. Right? So what did we have happen ahead of the rout that happened in November? We had retail buying, because retail is really the biggest buyers of premium and the biggest sellers of premium in calls and puts of equities, right? So you had record levels, like never before in the history of the stock market, buying of call premium in equities and selling a put premium in equities. And that was a big red flag. The more exuberance you see in bullish positioning, the more likely it is you're going to see things roll over. You also had managed money get leveraged long. You had a lot of extremes happening. The velocity of the move, bottom that we formed was pretty staggering as well. So that's something to keep in mind when you see those kinds of indications that the market's getting a little ahead of itself. And the aftermath of that is typically going to be higher levels of volatility. So let's just talk about one more thing. We're in a different volatility environment. It started in the third quarter of 2021. It's sort of leptocritic. It's something that Jem Carson's talked about as well. And what that means is the distribution of fat tail risk is much more expansive. And that means that you've got very powerful amounts of energy in the market, both on the buy side and the sell side. A lot of this has to do with leverage and too much positioning that exaggerates price moves. And so what we saw yesterday, what we saw in October and November and December during some of those really big down and updates, that's that sort of leptokurtosis. That's that idea that, if one side, sellers or buyers, pushes too hard, it overwhelms the other side and you get this outsized move up or down. That's part of this new volatility regime that we exist in. And yesterday was a perfect example of that. And we're likely to see more of it both up and down in the days, weeks, and months to come. Especially if the Fed doesn't pivot. And so that's something to pay attention to insofar as position sizing. If you're trading or investing, especially if you're employing any leverage or options, you may have a different distribution of risk, than you had prior. So that's something to keep in mind, that no matter what happens, but especially if the Fed doesn't pivot, we could continue to see a lot of these whipsaws. So that's one thing. Now, to address the other thing Rahul asked about hedge funds selling down tech, from a contrarian standpoint, it's constructive to see that. You want to see the leverage players leaving the space, and hedge funds, despite the mythos about them, they aren't really smart money. If you backtest a lot of the signals that you get, hedge funds buying, hedge funds selling, they're usually better to be faded. So that's the contrarian take. Doesn't mean we're out of the woods. But it does mean you're getting some of that leverage out of those names. And so maybe some of them that are higher quality, that are producing free cash flow, that have good management, that they have a strong moat, maybe some of them are worth nibbling at along the edges. But again, you're kind of betting against the Fed, right? They always say don't fight the Fed. So be careful about that, because if the Fed truly does not pivot and they really are intent of removing liquidity from the system, then it is very likely that could kick off a meaningful correction or worse. And I just want to say that I'm not being a chicken little. If you guys follow me on Twitter, I try to keep it pretty level-headed, but this is pretty bearish stuff on a macro level, at a Fed policy level to digest. And, we still don't have markets pricing in a terminal rate on Fed funds above 2%. So markets still haven't priced in what the Fed has broadcasted. They really haven't priced in balance sheet reduction either. So that's something that's important, that the markets are still kind of sort of trying to call the Fed's bluff. And whether the market's right or the Fed's right, we don't know yet. We time and price and the events that happen in the days, weeks, and months to come are going to define that for us, right? So for us as investors and market participants, we have to be more cognizant of volatility, of the econometrics, of Fed speak and actions, and the technical patterns that are playing out in the market. And it's earnings season, so we also got to be on top of those fundamentals. So that's my 2 cents. I know it doesn't give us a lot of certainty, because really we're in an area with higher than usual uncertainty. So I don't want to try to look into a crystal ball and tell you all what's going to happen. I instead want to try to give you some of the tools and some of the things that I look at, so that maybe you can be more informed about the decisions you're making with your investments and your trading.
Amazing stuff as always,
Well
MM.
done.
Absolutely crushed it. One of my friends, Sagar, I think he's on, just pinged me on while we were chatting. GameStop just announced they're doing NFT marketplace and they're up 18%. This is absurd. Like, is this still a thing? Where a headline comes out for a meme stock and they rip, while Coinbase has a $2 million active user waiting list for NFT, has the tools and exposure and the platform, and the stock just tanks every day. This is unbelievable, to be honest. But going on, again, if anyone has any questions, MM's on for a short period. The rest of us are on as well. If you want to continue that question, you can. Jalen, I think you were going to chime into Mahesh's question. I forgot the question, but if you remember it.
I just had a quick follow-up on a macro that MM was talking about with the question. So the biggest takeaway I get from all of this is the hastening of the QT plans from the Fed. That was the unexpected change in the markets, and that's what really caused the sell-off that we saw. But connecting that with the ADP numbers that came out and the ADP number coming out tomorrow, given that I think Renmac commented how participants at the minutes for the meeting on December noted that labor market conditions are consistent with maximum employment as it stands right now. If NFP numbers tomorrow are good and even better than expected, does that indicate that potentially the Fed continues on this quicker pivot and hastens their plan even more?
So that's a really good question. And I think that, yes, the Fed is watching a couple of employment econometrics. They're watching unemployment. They're watching NFP. They're also watching labor force participation rate. 2 out of 3 ain't bad, I guess, because they do have progress in the unemployment rate and, in non-farm payrolls that we've seen. So tomorrow's going to be important, absolutely, as to what they tell us in January, as is inflationary data and any other kind of econometrics that they're watching closely. Those are all things that we should be watching on the economic calendar in the weeks ahead. If you continue to get strong employment prints, they can say, hey, look, the one side of our mandate has been accomplished, as they're kind of hinting at in their minutes. And, the only place that you can look that you really don't see that being true is labor force participation has been languishing really for decades. We haven't ever normalized labor force participation, in particular for the 18 to 50 component of the workforce demographics. So there is still a lot of slack in this economy, despite, hearing, there's all these open jobs and it's hard to find people and so forth. There still is a lot of slack in the workforce. Now, part of that has to do with labor force participation rate as an antiquated metric. You've got a lot more gig workers, Uber, Dash, that kind of part of the economy, Fiverr and Upwork and all that kind of stuff is certainly changing those paradigms. You've also got a lot more people starting small businesses. So the founders of those businesses, often of which only have a couple people working for them, are not counted in the workforce either. So there are some offsetting things, and the Fed's probably more aware of that data because they've got a more comprehensive kind of aggregation mechanism for all the macro they can look at out there and some pretty good models overall. So I would say, overall, 2 out of 3 ain't bad. And maybe on the third, they're actually making more progress than it looks like on the surface. So yeah, that gives them the capacity to say that, from what we see, so they cover their butts, it looks pretty good. And we're concerned about inflation. Now, I've talked about this at length on Twitter and in in essence, there's not much the Fed can do about cost push inflation, and that is one of the drivers. I think it's the primary driver. The second is demand driven from fiscal and some of the other factors that are going on. But the Fed, there's really not a lot they could do to improve supply chains. Like the Fed can't tell China to open up their port that they closed over COVID. They can't tell Canada to move lumber mills closer to forests. They can't do a lot of stuff to resolve some of these structural issues. So if they actually increase rates and tighten liquidity, some of the more leveraged players in the supply chain may actually have to pass on cost increases on their funding to other parts of the supply chain. So it could actually, in some ways, worsen cost push inflation. So it's going to be really interesting to see how they balance it.
I actually just shared that thread you wrote last night, MM, on I don't think the Fed can control cost push inflation. And then I think there's 7, 8 tweets following up. So if anyone didn't check that out, it's a pretty good summary of what MM just said.
Thanks, Rahul.
It's pinned above. Yeah, you're welcome.
And that's not to say they won't try. The Fed loves to do things that they don't necessarily out to do, and sometimes cause issues because of that. And we've seen that going into this. I think they put a little too much liquidity into the system a little too rapidly. That wall of liquidity caused 2020 to be one of the best years ever if you were investing in some of the sectors that are benefiting from that wall of liquidity. And so when that wall of liquidity peaked in February to May of last year, that's also when a lot of that same stuff rolled over, right? So you saw the People's Bank of China pulling back. You saw a couple of other central banks beginning to talk about pulling back, and the velocity of that liquidity started to drop off. And with it, you saw SPACs and small to mid cap growth, and you saw biotechs and Chinese stocks all kind of roll over. And so that's important because the liquidity has driven this market. This is not a market that's driven primarily by economic data or earnings. It's a market that's primarily driven by low funding costs and an abundance of liquidity. And that's why it's so important to watch central bank actions.
Very true. Well said, MM, and thanks for posing that question, Mahesh. 2020, the year of active trader. Did you have a question? All right, guess not.
And I gotta run, guys. I'm gonna be doing an interview, so I'm sorry to cut it short, but I hope this was helpful. And everyone, the very best. Tomorrow's the last trading day of the week. It's also the first trading week of the year, and that kind of can define some of the rotations we expect from institutions. And so far, it seems to be favoring cyclicals a little more, the late cycle plays. So just something to watch, guys. Watch the flows, watch which sectors are in favor, watch the macro, watch volatility, look at what the Fed's doing and also what they're saying, and look at what other central banks around the world are doing as well, like the People's Bank of China may be pivoting dovish. So let's look at all this together. I'll keep covering it on Twitter. We'll keep talking about it on Spaces, and we'll try to get through this year the best we can.
Of course, and give MM a follow if you don't. This guy is absolutely a machine, and that's why I love hearing from him. So thanks for joining in, MM. Appreciate that. Chet, at Modern Growth Investing, did you have a question?
My question is like pretty simple. I'm like a one-trick pony. I have just one strategy. Like I buy a business and sit on it, and I hope it's a quality business, and hopefully it will appreciate over the long term. In that regards, whatever Markets and Mayhem was talking about, and a lot of people have been talking about, I feel like these things are mainly for next 6 months to 12 months, right? If I'm a really long-term investor, I think only the thing that will matter for me is the rates, right? If the interest rate goes up, and if a few of my businesses that are using leverage, the cost of capital goes up, and in only that case, I have to worry about it, right? And even in that case, if the rates go up to 2% or 4% or even 5%, for some of my businesses, it wouldn't even matter because they are growing at like 30, 40%. So I just wanted to get a feel about my statements from y'all because it's a totally different world I'm looking at from my point of view. So I just wanted to know.
I mean, I'm kind of in your boat too. I'm trying to focus on long-term investing and picking, the best companies and trying to hold them for the longest period of time. The challenge with that is, I'll use an example, Cloudflare. I thought the company was amazing at $60, right? Bought in, went heavy in March, April, and it ran to 210. And the problem with this theory of long-term investing is, you have to come up with some sort of, I guess, valuation or price you expect the company that you want to kind of start considering taking some profits. And when it happens so rapid, and then you see all this market reaction in terms of the macroeconomic policy changing, and then you see growth stocks correcting so quick, I think it's a good learning lesson because, at that time, it's hard to evaluate. You're just thinking that I want to hold on and not lose those shares and not lose that cost basis. But, I mean, going 5x, or not 5x, or 3-4x in 6 months, and having all these, and the problem is also these companies that do a great job of marketing and sharing like all their products and services and continuing to try to expand and being very aggressive. That's one part of assessing a stock, right? But then these macro factors, while I agree with you, it's not a direct effect in the longer term. But I think, I mean, if you trade sideways for a year, two, even 2 years, right? It's tough, right? It's not going to be easy, and I don't think any of us are well versed in that type of environment because, quite honestly, no one, unless you've been investing prior to 09, I don't think you've really truly seen it. You've also seen a lot of these secular trends take a lot more, I guess, traction in the past decade. So you're seeing those stocks benefit off, just organic business growth, secular adoption, digital acceleration, as well as a very accommodating macro kind of economic policy. So while I see what you're saying in terms of rates not directly affecting businesses if they have the revenue and the income to kind of continue growing, but you can't grow as fast as you'd like, right? It also affects market sentiment. It affects the way you can get institutional money, right? So there is still, I guess, a trickle down effect on these businesses, and I do think that it's just not a market that many of us, I guess, can truly say we know how to kind of hold. And I think that's something we're going to see through 2022, right? Who sticks around and who's truly a long-term investor? Because what happened in FinTwit the past couple of years was everyone called themselves a long-term investor. I mean, half these accounts, I said it earlier, right? They've gone cartoons. They're actually long-term investors? Probably not. So it's truly important who you guys follow on Twitter to make sure you understand what their real motives are, because what's happening in the past 6 weeks is probably shaking out a lot of people and accounts as well. But yeah, that's just my 2 cents. I see we have a couple other folks. Dylan, what's going on, man? Anyone else want to chime in? Feel free to.
Yeah, I think when we think to ourselves, like,
being a long-term investor, and now I do consider myself as a long-term investor, right? I have not switched. For those who do follow me, I have not switched my narrative. I still believe in the companies that I constantly buy, especially if they have growing revenue and growing earnings. But there is a big factor that a lot of retail investors constantly overlook. And especially when you start thinking about an interest rate environment or an environment where liquidity is tightening, and that is the bottom line metrics to a lot of these companies. So a lot of people would think to themselves, this is the world's best company because of XYZ technology, whatever it might end up being. But if the stock is still unprofitable, and if it's still not projected to be profitable within the next years, the market's going to understand that. And that's going to come into strong focus. So if you actually look at, I think it's Digital Turbine, so ticker symbol APPS, or even like Pubmatic, or another stock that I own is actually going to be Brilliant Earth. And that's a profitable, small little, it's actually a jeweler. So, but all these stocks, they're trading essentially sideways. And when this happens, it's not because of some sort of weird magical factor. It's because they have bottom line metrics that provide them with a floor. So what you're seeing here is with these tightening liquidity conditions, is that it's essentially putting these valuations into picture. Because I think I ended up posting I think it was about a month or two ago, where I started to notice that Net was trading, or Cloudflare, whatever you want to call it, ticker symbol Net, that it was trading at like 108 price to sales ratio. Now, I'm not bagging on the company, and I'm not saying that company is a bad company, but it could realistically take 3 to 4 years before you see that valuation again. So a lot of these companies, when you are investing into a contracting liquidity environment, EBITDA or PE ratios come into picture. They always will. And you cannot overlook like this price to sales ratio. So even like amazing companies that I absolutely love, like Sentinel-1, Confluent, like these companies I absolutely love, but their PE ratios are coming into question, which is why you see them getting hit the hardest. So I think that when a lot of people think that, everything's going to be fine, but for the past 2 years, we've been living in this liquidity environment, which is essentially what has trained us and programmed us to buy the dip and to buy every dip, regardless of valuation. Cloudflare's 30% off of its highs. Let's throw $10,000 into the stock. But the thing is, that stock probably has another 50% left to go down in order to come down to a moderate valuation, because this is what institutions are going to be looking at. So it's like, sure, the company could be a great company, but I think Mark Minervini on Twitter said it best. What a lot of investors overlook is that you need a buyer. So you need people to want to buy the stock, and you have to universally understand what big money and a lot of other people want to buy the stock at. And that is typically going to be with appropriate valuations, which are typically going to be in forward PE. I'm not a big fan of trailing 12-month PE unless it's a large cap, more mature company. But forward PE, EBITDA or enterprise value EBITDA. So I think that a lot of these companies, they still have a lot further left to fall, because Confluent's trading at like 35 forward price to sales. Sentinel-1's at like 32 or 34, I think. But a lot of these companies, you really do have to think to yourself, what's their gross profit margin? What is their operating profit margin? What's their EBITDA? And what is their earnings? And if you can justify it from a profitability perspective, it is most likely going to be in a place where you can actually yield some sort of return in 2022. Because I think that another thing that's really, really important to understand is that a majority of us are going to be millennials, people in between the ages, and I've seen my audience dynamics, they're typically in between the ages of like 22, 23, all the way up to about 40. So a lot of us are going to be in the millennial generation, and a lot of us didn't necessarily experience the 2008 financial crisis or even the 1999 dot-com bubble, which really says, it brings in a picture that secular bear markets do happen. Like, we have to understand that. And the Fed, there's a potential here that if the Fed does go down this road, that if they decide to do this once, they've never done this before, right? The 1970s is the only other time that we can ever think about a Fed being this aggressive. So like if you look back at the 1970s, the Fed ended up coming on in and they raised interest rates aggressively up to 20%, and it crashed the markets twice in a 10-year period. There was a 49% decline the first time. And then after that, there was going to be a 29% decline. And this was to combat inflation. Now, this has not happened for years. So this is the next time that we've actually seen, and the 1980s is the last time that we can see that CPI inflation has gotten this out of control. And then the Fed's whole purpose is to make sure that they're monitoring inflation. If they do go down this road where CPI data comes in hot next month, and then even a month after that, while we're quantitative, or not quantitative either, while we're tapering and CPI continues to remain hot, the Fed will do what they have to do to control inflation. And that will be a balance sheet runoff, and that will be raising rates, and that will be completing taper, all within a few months period. And the last time the Fed did this, we saw a decline in the S&P 500 by 49%. And I think that that's important for people to understand that with our investing journeys, that we will see a secular bear market at some point, just from odds perspective. Like, we're going to see a secular bear market at some point, and always being cognizant that possibility is there. It makes sure that we're not investing into these companies that do have this 40x price to sales ratio. Or even more asinine is when you start seeing 108x price to sales ratio completely disregards the valuation. The stock doubles in a 2 to 3 month period. It's the greatest thing in the world. And you start seeing a bunch of Twitter spaces about it. It's just like, okay, that's usually when it's at an all-time high, and it's probably not going to see that valuation for a while. But it's just, and I'm not trying to be bearish, and I'm not trying to be pessimistic, but this is just more realistic, right? I'm not trying to be like, saying talk down to anybody, but this is a very real thing. Declines of 40% in the S&P 500 have happened, and they happened not too long ago. And what we've recently seen is just this massive pump of liquidity, unprecedented. It's historical. We've never seen it. Like 2008, it was 40% of all money in circulation was printed in the past 2 years. We've never seen this much. And then now they're finally responding to this. And you can't help but think that this historical bubble that we've seen, and not only that, but you actually compare the ARK Innovation Fund to the 1999 NASDAQ, they're identical. Like the chart pattern is identical. So essentially what we did is we had this QE fuel bubble, and now they're backpedaling in this. And now we're getting to a point where they're going to start tightening monetary policy. And I'm not saying that we're going to head to a secular bear market, but I'm saying that there's conditions here that we should be aware of as investors. And especially when we say that we're long-term investors, you should definitely be thinking to yourself, okay, what is the risk that I'm getting myself into? Is the company profitable? Because when these bear markets do happen, these earnings and these valuations, they come into picture. And then when they finally bottom out is when these stocks get very, very cheap. And that also includes Apple, Microsoft, Google, all those guys, all the FANG M, right? Historically, they've been trading at a 10 to 15 trailing 12-month PE. That's historically what it's been since the 2008 financial crisis until 2018, 2019. And then all of a sudden now you see Apple trading at a 32.4 price to sales with like a 1.2% CAGR. Well, that ends up being about like 3% growth projected over the next 3 years with a 32.4 PE. And I understand that it has like a return on capital that's just never been so great. But what I'm trying to say here, and I'm trying to put on the context here, is that prices are still high. And the Fed is about to tighten liquidity. And it's like, we just got to pay attention to this because these things do happen. And I'm always saying this because we got to think about it. I'm not saying it's going to happen, but we have to understand it and think about it.
No, 100% agree, Dylan. And thanks for breaking that down. I think we've said this, I think, past 3-4 days we've been on Space Daily, and we've been kind of highlighting a lot of similar, points, Thesis, and I think we got into the mathematical calculation too from the Fed's balance sheet on, how much is pinned off the U.S. dollar. So a lot at stake for this unwinding of the liquidity that, like Dylan and MM has mentioned, all of us have talked about. I think we're going to post our recordings from Sunday because we've, I think, covered this topic probably over 10 hours just this week. So, Luke, I'll send that to you when I have a chance. And again, I know we get a lot of questions on these recordings. Some of these are already recorded here, so we shared them through the tweet when it's over. The only one we didn't do was yesterday. That ended up being the 4.5-hour one. So we'll get them on YouTube as well. I see some more questions coming in, and some of the things that Dylan highlighted are actually pinned a tweet above that I had written. Before you buy a company, are you looking at XYZ, right? So there's a lot of things that I wrote up there in terms of margins and the problems the company's trying to solve, and some of the points Dylan highlighted. So I think it would be very useful context if you heard that, and if you want to look into that further, probably help some of you guys. But let's take some more questions, I guess. Yawar Tower. Are you there? I think we have more questions coming in.
He's gone.
Are you? Who just spoke? I don't even see who spoke.
I spoke. Oh, it's me.
Oh, KT. Oh, sorry.
Yeah.
What's up?
No. I think he dropped off.
Oh, okay. Hold on, we have a couple more people. Laura came back. Hold on. George HH, did you have a question?
Oh yeah, just quickly. So I think listening to Twitter Spaces and everyone on Twitter, I think overwhelmingly the easy decision is to be bearish now. And I just sort of wanted to flip it on its head and ask, what would the bull thesis right now be? So sort of, if the easy trade is to be bearish, what would require? What is the bull thesis right now?
Can I take this real quick? Anyone mind? Okay, cool.
No, go for it.
So, because I'm pretty bearish. I mean, you go all cash. That's not something I take pretty lightly. And I've been sticking in this market as best I could. And people will not like this. I really want to see the indexes break down. So I really do want to see more pain. Or this for another answer for you. I'm really looking at price actions to really. I want to start seeing some bases around here. I am not seeing like anything really constructively. I think there's a few that I've started to PayPal, and then I know one of my friends, Sean Jiggy Capital, Lightspeed is starting to give some bottoming action, but really, I need to see kind of 8 weeks here of not much up, not much down, and just staying flat. That's really what would get me more excited about the market. But that's kind of a simple technical evaluation of what I'm seeing. But I think you really need to see some blood in these indexes. Again, I don't want to be bearish. I hate being bearish. I'd much rather us all make money, but that's what I'm looking for. So my 2 cents.
Totally fair. I guess since we have so many speakers, maybe we can use the hand emoji. I think that's kind of helpful for me to rotate. I think, Dylan, did you have something to add?
Yeah, so like I love thinking about this, and I think that was a fantastic question because on every single trade that you make and how you position your portfolio, you have to think about the way that you think it's going to go and the way that you think that it's not going to go, and you have to make sure that you're adjusting both scenarios appropriately based upon your current knowledge, right? So I have thought to myself, okay, I position myself defensively, meaning that I've shorted various different stocks and ETFs, thinking to myself, okay, there could potentially be a downturn, but in this particular case, I have thought about the ulterior scenario where, in this particular case, we do see a massive rally in the ARK Innovation Fund and the IWO, and everything reverses and everything goes hunky dory for 2022, right? What would that look like? And then the number one thing that I have to say is that it's all of inflation, right? Because that's the whole reason why the small caps have not traded well all of 2021 is because when you think about inflation, that this has to do with pricing power. This is why the major companies have done so well because they have pricing power. We need Apple products. We need Google. We need Amazon. And we need NVIDIA, especially because of how much they've improved over the past couple of years. So inflation must abate. And if it does, then we will likely see a reversal in the indexes and just in this trade in general, because that's why everything's so wonky, is it's all about inflation.
I think that just add a quick thing to that. In terms of the bull thesis, definitely like.
Hold on one second, Mahesh. I see you wanted to chime in. Just want to go in order though. George, first of all, does that answer your question, or do you want us to continue expanding on that?
Yeah, that was brilliant. I was just one more thing to add to it. I think for me, sort of we've seen sort of a passing of the old guard in the COVID names. And do you think there's a case of a lot of people are waiting for the first round of earnings now and then sort of they making their decision of what growth stocks to get into once you've seen sort of the next round of earnings, and potentially that could be a big changing point in people positioning their growth portfolios from the old COVID names to sort of the next generation, whether that be the Unities and the Dockins, which recently did well.
Yeah, I think earnings could be a great catalyst of volume coming into the stock, right? And when I say volume coming in, I'm looking for, volume that screams out, hey, I don't care what it's at right now. I need to get as much of it as I can. So you'll get your clues. Things will start. There's still screens you can run that'll show stocks that are really holding up well. But again, you don't want to write all of these off. It's just that they're expensive now if we start doing QT. I've never experienced QT, but if we're taking money from a bathtub and we're now taking it out, it's not going to go well. But earnings will be important. I mean, these markets still have to execute. So
I don't know if that's Eric or the spaces. There's some like crazy lawnmower or something going off in the back.
I think I'm hearing that too
Yeah,
when he's speaking.
I'm just going to try to mute him and unmute him, but Eric, if you want to check, I don't know if it's your phone or you're kind of at Six Flags or something. But hopefully that answers your question a little bit, George. Thanks for asking. Yawar, I think you were next.
Oh yeah, I wanted to ask. Dylan brought up a very good point about inflation, being unlike those, the big fan companies having a lot of price power, while the threat of quantitative tightening has brought a lot of these growth stocks down. I was wondering, we haven't seen quantitative tightening play out since 2019 when it was abruptly stopped. So if quantitative tightening does happen, are y'all planning on going fully cash or shorting the market or staying invested in growth stocks and hoping that there isn't any further decline right now?
So I'd love to answer both George's and yours, if that's okay. But I see that, is it Garage that has his hand up?
I think he has a question, so we'll get to him next. We can answer this first.
So George, in relation to your question, and I will answer yours here in just a second. George, in relation to your answer, earnings will dictate the price of the market, but it's not going to be the earnings calls that you're most likely going to be listening to. What I've noticed is that over time, a lot of the bigger companies, their earnings calls aren't necessarily surrounded about business performance, but it has to do a lot with market dynamics. So this is typically where a lot of the funds, institutions, and big banks get a lot of their information from, is that they have their analysts sit on these calls and they're asking questions about market dynamics and what they're seeing in terms of inflation, right? So this has everything, like I mentioned before, this whole price action, this whole crazy market has everything to do with inflation. And this is why people who have been investing for the past 10 to 12 years haven't seen this, because there has been no inflation. It's definitely been under 2%. So when you think about it, yes, earnings could create a massive catalyst and a massive reversal. But it's only in the case that if you do listen to like JP Morgan's analyst call or like Apple's call, or it could be even like FedEx or UPS. These guys are typically going to have insight on what's going on with the supply chain out there and what's going on with the inflation trends. And if you do have time, they're most likely going to answer a lot of these questions that you have. But one person, it's very, very difficult to find that, right? So we could start seeing a reversal in a lot. And that's exactly why you ended up seeing a lot of our growth stocks sell off during last earnings, is because we didn't know that a lot of this stuff was going to happen. But they're listening to the CEOs, and that's like getting the information from the horse's mouth, right? So you're getting a lot. These CEOs and these executives, they're paid millions of dollars because they know what they're doing, and they know what's going on in their respective markets. And then these analysts, they take that information and they apply it to their trades, and they apply it to their portfolio positioning. So that was a long-winded response, but yes, earnings could change a lot of things, but it's not going to necessarily be the earnings calls that you would most likely not even have time, especially if you have a job or a business that you have to run, find time to listen to all those calls. But in relation to Yawar, if the Fed does quantitative tightening, then my overall strategy, and this is because because this is my personal situation, right? And this has a lot to do with how I'm positioned financially. And personal finance, especially as a retail investor, is important. Like, what is your cash flow every single month? Like, what are your other assets doing? How is your portfolio positioned? So like a lot of these different things are subjective from person to person. And so it's definitely not financial advice. This is just my strategy. I know that it goes back to like what I mentioned before. These bear markets and these sell-offs almost always put valuation into perspective. So I do have cash. It's defensive for me is like 10 to 15% cash. I'm almost always fully invested at all times, but I do hedge and I do short stocks. And I do that simultaneously while going long on the positions that I like. So I know that if you can find the time to study and to learn how to short or how to hedge your portfolio and understand the various different shorting strategies, I definitely suggest that would be a good place to get started. And in particular, what I'm running right now it's called a long short strategy. So it's what hedge funds do, but it takes a little bit of time to get down.
Yeah, I wouldn't say I'm planning on going full cash or anything of that extreme, but like we've been on Spaces daily pretty much discussing this and QT, the effects it's going to have, and rate hikes, so certainly watching it. I think this earnings is definitely going to be a big one. I pointed out yesterday, not only are you going to get earnings, you're going to get Q 2022 guidance, which is going to be important because these numbers and valuations are going to only matter more with this shift in macroeconomic policy. So it's too early to say if someone's going to go all cash. At least I can't say that. I can't answer. I can only speak to myself. But what I will say is, I think the times of YOLOing stocks and just throwing darts on a board are certainly well behind us. And I think it's important to understand the assets you're purchasing and not just purely speculating. Even if it's a risky asset, just make sure you have a thesis and conviction. That's all I can say. I mean, like I think Jay Lynn pointed out earlier, equities are risky assets, right? So regardless of the valuation, I mean, it's not like clearly safe, right? You have bonds and CDs and other instruments that are much safer. So just, I guess, like I said, this sounds very niche, but you have to have that conviction. Like, why else are you buying it? I genuinely don't understand that when people just throw money at something and want to just run with it. That means you're at a casino. You're just trying to win money. Like, it's not about winning. It's about earning. It's a big difference. So, yeah. Garage, you've been waiting. Did you have a question?
Yeah. So this is the first time in my in this talk. So is this talk pertaining to really the equity markets only, equity securities, ETFs?
I'd say so. I
options?
mean, yeah.
Okay.
I mean,
Oh,
I
okay.
think some of us are on crypto, but I wouldn't feel comfortable speaking too in depth outside of Ethereum. That's probably the only place that I can speak to a little bit on the crypto side.
Okay, well, I'm just more of a diversified because when we talk about inflation, when we talk about cyclical economies, we talk about all of these ups and downs. It's reality. We have to make sure our portfolio is well in balance with the bonds, cash, equities, commercial paper, anything else. I have gold certificates, that kind of thing. So I'm a very kind of an evened out, diversified investor, and that helps you ride out the waves that we will go through. I would say in the next year or so.
If I could chime in just a little bit on that, I think what Dylan mentioned earlier, the similarity between ARK and the 99 NASDAQ chart, and specifically the recovery period following that, is something to be cautious of because
Did he drop off?
Not sure. Not sure what just
I
happened.
can't hear you.
Yeah, I think someone just dropped off. Jalen or anyone? Jalen, we haven't heard from you in a while. Do you want to chime in?
Yeah, I mean, I think the conversation that's going on right now is great. I was gonna, when someone was talking about like what would a bull case be, I was gonna hop in and say, we have to see how this higher yield environment is going to affect margins for, especially these large cap tech stocks right now, if they're still going to be able to sustain their, EPS valuations that they've been holding for these last couple of years in the added liquidity environment. One thing that I do have to like kind of exclamate here is that we've been talking about this notion of inflation, right? And how the Fed's going to have to step in to ease inflation. But I think the topic of concern for me that is, much unknown for personally myself and maybe even the Federal Reserve is that we don't necessarily know the main causes for inflation here, right? Like, I think there might be a lot of supply side issues that they might not necessarily have the tools to control. So from yesterday, my biggest takeaway from the sell-off yesterday was that Wall Street and these institutions that have, highly leveraged, equity holdings kind of got a little worried that the Fed was going to step in and say they might start QT right after the first rate hike. I think expectations were that the Fed might, continue to taper their asset buybacks and then watch if the velocity of inflation and the supply side bottlenecks started to clear up on their own, and if it would have, effects to the PCE and CPI prints we saw throughout this year. So just kind of moving in like a quick manner for the Fed here, and just the rate of what their, overall decision is and when they move forward to whether it is to reduce their balance sheet, or just cut the liquidity that they've been injecting thus far, especially, adding the interest rate hikes. I just think the notion of what exactly they're going to do is much uncertain, and the causes for concern with inflation are also much kind of in uncharted territory right now. So that's the, this weird conundrum that the markets have found themselves in within these last couple of weeks.
Yeah, definitely fair. And good point, Jalen. Did Garage leave? I always like checking with the person if that helped them, but I guess he might have left. Goku, what's going on, Goku?
What's going on, man? Appreciate it. So, yeah, Jeremy actually answered my question, so I'll just be short here. But I wanted to get somebody's bull case. I'm of the same sentiment as Dylan. You've got NTM multiples that are crazy. People feel like the indices can't get hit when, I'm hoping to see that from just a health perspective, the amount of QE. And, even though they've announced taper and we know that everything's going to happen in the market faster than, when they actually announce, they're still flooding, their asset, buybacks, and we have these supply chain issues. So, I long and short both ways. So I'm hoping there's some sort of normalization and want to see what happens with the next earnings to give us a better view. But I was kind of looking to check my bias and get somebody's bull thesis because it's great to have both sides of the picture.
Yeah, it's kind of literally what we've been kind of going back and forth with the past few days. And I agree. I think this earnings it's going to be huge, but I think not only just the earnings, I think just keeping in track with what the Fed, not only what the Fed is doing, but the volatile events that are going to surround the Fed. I think MM talked about yesterday how there is massive options expiring this month compared historically, and the earnings kick right off right after that. And then just keeping up with, I guess, we're getting these day-to-day swings in what the Fed is trying to say, and also understanding how things trade to the comparables in that industry, I think is important as well. But a lot going on. This conversation, I think, is just going to continue for days and days and weeks, and I think we're going to see who sticks around and who doesn't. TSDR, what's going on? I think we have you up here.
What up? Can you hear me?
Yeah, what's going on, bro? Are you driving again?
Yeah, I'm in my. So I was. I'm on my way back home. So I never know what, depending on what car, if I'm in our minivan or if I'm in our other car. I never know how it works. I was thinking when you guys were just talking about the Fed. I'm looking forward to the next couple Fed events and the remarks, I should say, because I kind of think that now they've pretty much said the worst that the market can hear. You could potentially assume
That's actually a great point. Yeah.
With very quick quantitative tightening potentially coming, immediately following the completion of the taper and the interest rate hikes. So at this point, it seems like they just got the worst news out of the way almost, and there's only potentially positive news to come out of the Fed. And either way, I think they're doing it correctly. What other choice do they have? The economy is hotter than all hell right now, and I think it's going to continue to remain strong to where, and if it, let's just say if it doesn't, if we cool down in the next couple of years, they have to raise rates quickly, and they have to reduce their balance sheet quickly. Otherwise, their hands are tied if the economy does eventually start to slow down at any point in the next 2 to 3 years. So, like I said, I think the worst news from the Fed is possibly out of the way for the next foreseeable future. I'm pretty short-sighted. So, anyways, just a little thought I had.
Yeah, definitely. No, heard you all, man. Good point. Appreciate that. Yeah, I think we didn't really hit on that. I said it yesterday. I think this could also be a placebo effect where the Fed is kind of saying something just to kind of get the reaction out of the way. And who knows what they do with the follow through. But yeah,
now can I add a counterpoint?
Go
hey
ahead,
guys, I'm back, by the way. Sorry about that.
Are you at Six Flags or are you at your house?
I guess the lawnmower decided to just completely roll through my room and just mow down whatever grass I had growing in here. So sorry about that.
All good.
The only thing, because that's a great point, right? Like, did we just hit the bottom of our sentiment? And I don't know, because wouldn't fund managers at some point, like even today, right, really come in and start bringing in the volume, or bringing in, really start getting prices, showing that they're really interested in buying stock? What I saw today was a lot of short covering too. I don't know. That's a great point, though. It's something maybe I even need to think more about, is that maybe did we hit a sentiment bottom? But that would be something to also consider of, like, if we did hit a bottom, well, then why isn't bigger money coming into the market either? So just a yin and a yang too. But that's a great point, by the way. So I appreciate that. I'll keep it in my my mind as well, because we want to lean bullish. Everyone wants to make money. This isn't about, I'm not happy, not being in stock. So good point. So thank you.
Thanks, Eric, and I like that response too, and that's something that I'll be looking at as potential confirmation or whatnot. I think that if that thesis is true about a potential sentiment bottom or max fear recently, then I think it will be more of a process. I think it'll be more process oriented to notice that accumulation trend. I would suspect, but I'm not sure.
And this is really where it helps to understand technical indicators, because I always live with the philosophy that you don't know what you don't know. And if somebody ever speaks in absolutes, like you just probably should never listen to that person because there's millions, tens of millions, hundreds of millions of people that participate in the markets. And there's one thing that really shows a trend reversal, and that's typically going to be a technical trend reversal. And that's really where my sights are on here, is that if you do follow price action, it provides, at least at the very minimum, a clue for you to reassess your thesis. And I think that for me, knowing that I'm short, various different ETFs and stocks, I do think to myself, okay, what am I looking for to exit this trade? And I do think that there's going to be a circumstance here where it could be a sentiment, but like ARK doesn't need to follow the 1999 NASDAQ similar trajectory. But what is the technical indicators I'm looking for to either cover my shorts or to reposition my portfolio differently? And what do I need to see to challenge my current thesis and challenge my current opinion? So I think that TSDR, I think that you make a fantastic point. We're sitting here talking about going all cash and shorting the market here, and we're FinTwit, and what is FinTwit ever right? But I do know that there's a limitless amount of possibilities, and there's one possibility here that's always certain, and that's price action.
Jalen, I see your hands up. Did you have anything to add?
Yeah, I think this is a great conversation. Obviously, no one should ever try and time a bottom, right? It's better to follow a trend and wait for a reversal confirmation. And as Dylan mentioned, technical indicators are, great proxies for someone to look at those points of reversal. Just one thing I wanted to add though is that markets are always forward-looking, right? So the news that we got yesterday was a little unexpected. Therefore, we saw the price action that we did yesterday, which was rampant selling. We were talking a bit about, quantitative tightening, how it's affected markets in the past. And just in my sole opinion here, I think if there were to be, a rampant downtrend that started, maybe like a secular bear market, as someone has mentioned, earlier in this, it would have to come from an earnings shock, maybe, later in the second half of this year, that actually shows that these companies aren't sustaining, their pre-revenue growth and pre-profitability with the lower liquidity in the system. So as long as, earnings are still pretty on par with what's going on, there's not going to be too aggressive price movements in this market, just based upon, sentiment and what the market thinks the Fed is going to do. So that's something to keep in mind as we go forward, heading into the months ahead.
Agreed.
I couldn't agree more. I think that was an absolutely phenomenal point. That this earnings season will be crucial to the next. I guess the first half of the year's earnings will be crucial to the next 18 months. And if these companies are able to produce, not produce isn't the right word, perform as expected in this future policy environment, then I don't think I think we could potentially be at the max fear policy wise and whatnot.
Yeah, there's so much going on. Well articulated. Jalen, I think, is definitely underfollowed. I've only heard from him on these spaces, and he's kind of become a regular guest. Happy to have him, but definitely give this guy a follow. I don't know why he only has 400. There's people that have hundreds, thousands, probably not speaking as well as him. So shout out to Jalen. Abdullah, did you have a question?
Hi, thanks, Rahul. This is the first time for me to even speak on space. I just the way I look at the market, and maybe it's only me, and I could be 100% wrong, but the way I look at it in the first half of this year, it's not going to be as strong as before. So mainly because of the Fed, and I watch the Fed closely that more than anything else, even more than I'm a growth and tech investor, and I've pulled out of the market almost like 90% cash early November, and everybody was saying I was crazy, and then it went south from there. So from the tapering, and I'm just asking you guys from the tapering, and this is my take from the tapering in March until March actually, and then if the Fed reduces their balance sheet, I can't see a very strong first half of 2022, and this is my take. Everybody is still optimistic about earnings and strong earnings and how important this first quarter of this year.
I mean, one
And then
second. I just want to make sure people understand this. I mean, that's fine if that's what you took away, but I think the majority of us are actually not optimistic. We're just saying that earnings could be the catalyst to help stabilize some of these dips. But I wouldn't say I think earnings are going to come and do something and show us something that's going to absolutely turn something around. But yeah, I just want to kind of
okay, great. So
clear that up.
then I'm following you guys. Yes. So okay, cool. Because I joined like 2 minutes ago or 3 minutes
Yeah,
ago.
yeah, no, we've been talking about this. It's just the concept. So the way I'd like to phrase it is, there's no catalyst right now. I think that can really turn things around. Earnings is the next catalyst coming up. Maybe that will help base for some of these stocks. But yeah, I'm not confident we see a good first half of the year either. We also have midterm elections coming up, so it's a very tricky time. Of what's going on for sure.
So just again, just a question to the general. Are you
Go
guys
for it.
like keeping like 80% cash, 20% cash? I know it depends, and it's a personal preference, but usually I hear like for me, I'm 90% cash. I could go for a quick swing like a day or two, but I can't leave my money in the market while it's very volatile. I can't even short
No,
because
I agree.
I've been hit so much with losses before, so I've learned my lesson to just listen to the Fed because they have the
Yeah,
upper hand.
you don't want to fight the Fed. I think I'd say percentage, I'm between 15 and 20% cash for now. I'm pretty well invested, but again, some of these positions are very old, and it's not like stuff I just bought. So it's just hard to just kind of completely rip something off. I definitely have sold in the past few months. Places that I found were a little riskier. Not definitely didn't sell enough. I should have sold a little bit more than I would have liked. But yeah, that's kind of where I am.
I mean, if history shows anything, in the past 20 years, the worst place to be is cash. And there have been environments like we're in right now, discussions like we're having right now. Over the past to 10, 12 years, and each and every time, cash has been the worst position to have. So, in my opinion, depending on how long your time horizon is, it's yeah. I mean, I don't want to sound rude, but I think the best thing to do is to be invested in a majority stake.
Yeah, man, I'm right there with you, TSDR. I think I'm like 80% long equity, 20% cash, 100% hedged on a one-to-one basis when you talk about my portfolio equity. Just because I have never, ever been in a situation where I thought to myself, man, I am so happy I sold that stock that I really, really liked on that market downturn. I always look back and I think to myself, oh, now it's at a higher cost basis because I missed it. Or maybe I overreacted and I sold too soon. So, and that's just, like I mentioned, I got my stock picking philosophy, but imagine if you're selling Google here right now, right? Or maybe you sold Tesla on the last growth stock sell-off and it was $450 per share, but you you thought the valuation was too high or whatever it might be, and now it's $1,000 per share, right? But these situations and these chances happen all the time when you have a really, really great company. And then, like I said, my 80% portfolio allocation in equities right now, I really, truly, it's like D-Local, Digital Turbine, Global E. Like these are companies that I really think have a strong secular tailwind behind them. And they are going to grow both revenue and earnings. So I'm right there with you, TSDR, and I think that is a good way to think.
It's funny. Some of these guys in the panel, KT might remember, I was getting mocked for not trimming Apple at 120 just a few months, like probably 5-6 months ago. So it's the reason I bring that up is because I'm I guess a little bit on the younger end or a millennial, whatever you want to call it. But owning companies like Apple and Microsoft have served my portfolio really well, right? Those are the companies that have done outstanding returns, and I think it's very hard to figure out when to exit. So that's why I'm not really here to figure out, I'm not here to make sells based on just macro policy. I need to see more to it. I think the macroeconomics are huge, but I think having a broken business, seeing a CEO leave, having a product fail, things of that nature would really, I guess, expedite me trying to sell a company. Or I guess what we've learned now in 2021 is also trimming into some of these names that just run up too fast, right? I think that's been the big lesson. And it's tough. It's no one's perfect, right? At this, it's not an easy game to play, right? This is why people say sometimes it's better to index and just let your money ride there, right? Because this is challenging. Go ahead, Luca, Eric.
Luca, do you want to go? I
No,
think
you can go.
you're
And then
on
I can
the
follow
more
up.
bearish train like me, so I figured let our buddy know that there are some people who are not as long term thinking and are a little shorter term. But want to hear your thoughts.
Yeah. So at this moment, if I were, I'm not necessarily picking a side. I really don't like predicting short term stuff. I just seem to, I just like following the technicals and what. At the end of the day, that's just how I roll. I'm more technical based than anything. But when it comes to the long term side, so a quick summary of what I have done over the past 3 months. So if we go back, and I'll get the best date's going to be if I just go to triple Q instead of digging through my orders. But if I go back and I take a look, I started trimming some things right around, when was it, 11:23ish, right there, right after we got a huge engulfing nasty bearish candle on triple Q off that high of 408. I didn't really like that, and I didn't really like how this fear surrounding the Fed was kicking up. Now, at that moment, I have to explain this for some background. On my longer term positions, I was sitting on large unrealized gains, quite a bit, and not as much cash as I wanted. So, in order to raise cash for what I thought we would get at some point, I did not know when, I trimmed back some positions, not by a much. In fact, it was like 2-3%, maybe 5% of the position I trimmed. I raised a little more cash, and I was like, you know what? This is going to be my buy the dip money to when I see the opportunity to actually add to these names and I see longer term opportunities. Now, to expand on what's in my long-term mix, I'm very much like KT actually noted earlier. I'm a little more isolated. I don't like to have, 20, 30 names in a portfolio. I like to have sub 10. So if you really look at my long-term positions, it's Apple, it's Nvidia, it's AMD. It is, go down the list of those type names, and they're the best of the breed in their respected areas. Now, there's one exception, that's Boeing, but my holdings right now, I'll just go down the list: Facebook, Nvidia, Apple, Boeing, Amazon, and AMD. Those are my long-term positions. I held them throughout 2021, and I trimmed a little at that time because I had quite a bit of unrealized gains. The one exception I didn't trim much was Amazon because it was building a base throughout most of the year. But I was sitting on large unrealized gains, and I wanted to trim a bit. So that's exactly what I did. But on my trading portfolio, I went from swings, and once we entered this choppy market, I said, okay, I'm going to be cash nearly every single night. I'm not going to hold much overnight because we're getting really choppy. There's a lot of fear building in the market, so I shortened my trade time frames down. I brought my stops tighter, and that's kind of how I operate. Now, when it comes to predicting what the Federal Reserve is going to do and how the market reacts to the Federal Reserve, right now, I think on a technical basis, it's pretty obvious the type of reaction we're getting. Every single time the Fed has come out and talked tightening, every single time they've talked taper, the market has reacted in a negative way. So, in the future here, when we get Fed actions that relate to tightening, when we get Fed actions that relate to that taper, I believe the market is likely going to react negatively rather than positive. So currently, I'm simply waiting for opportunities when it comes to these companies that I want to invest in for the long term. So in all likelihood, I'll be adding back to some of those positions I trimmed, but I'll also be looking to add new names. Now, the tough part here is what names are going to perform the best throughout this volatility, I would say, this Federal Reserve induced volatility. What names are going to basically produce the best returns. Now, I look at the next year, and I really do think that the theme is going to be positive free cash flow. And also, I think it's going to be these best of breed companies that outperform their sectors, or the best companies in basically their industry or where they perform. So That's, for instance, why I am not selling much Apple at all. I'm going to hold Apple probably until I die, or unless something fundamentally changes with the company. But I do think it's incorrect for you to compare, for instance, while I really like Cloudflare and I like that the company is growing and I like what they do, it's trading at a very high multiple, and I don't think it is comparable. It's really not to an Apple or an Amazon or a Facebook. It is simply not comparable. You look at those FANG names, and they have the best balance sheets out of almost any company you look at. They have some of the best balance sheets. They are the largest companies on planet Earth, and their businesses, when it comes to their industries proposed, their businesses, they're the leaders. They're the straight leaders. They run the industries, and they produce enough cash that if they want to jump in on a new vertical on any given day, they can do it and probably be successful. I mean, look at some of the products Apple has come out with. I mean, the way Apple operates is insane to me. They could probably come out with any product and sell it well. I know that's a crazy statement, but they've had a history of doing that. Now, I'm not necessarily bearish, but I'm definitely skeptical. I'm going into this market and I'm skeptical of everything. I'm skeptical of breakouts. I'm skeptical of swings. And that's how I'm going to operate until the technicals start to go back in my favor. That's simply how you have to operate. Once the market gets volatile, I think you just have to be a little skeptical. You know, we've seen over the past 2 months that breakouts have not been nearly as you could say great. That's a very, they haven't been as large, or they haven't been followed through. The breakouts have been very quick, but they haven't been sizable. The runs haven't been as large. Technical patterns aren't really following through as much. A lot of them are breaking to the downside, and that is why I'm positioned to the way I am. That is why I'm sitting on cash, and that's why I'm very in and out of the market. Now, once we start to get back in a trend, whether that's to the downside or the upside, then you can start adapting to the market. And that really leads me into my main point, is you have to adapt with the market. You have to make micro adjustments sometimes to your strategy when the market truly does change. Over the past 2 years, the market has mostly been in an uptrend. It has been trending to the upside. Your breakouts have been large and profitable. And as a trader and an investor, I have absolutely loved it. But over the past 3 months, we have kind of run into this choppy, volatile, nasty action, and you just have to adapt. So at the end of the day, the market, and really when it comes down to navigating the market, you always have to be learning from this market. You always have to be adapting and nimble with the markets. But if you do that and you keep your core system the same and you keep your core strategy the same, I think you will continue to be successful. I'm not going to predict where the markets go. If we enter a bear market, so be it. I'll adjust the strategy and figure out a way to trade the damn bear market. And if we keep going up, then fine. I'm going to stick with my same exact strategy. I'm going to scale up when we come out of this chop, and I'm going to play it. And if we keep chopping, I'm going to keep the same exact strategy I am now that has been working and making me those little gains that continue to compound. Because you can't go for home runs, in my opinion, in a choppy market. You have to take the small gains when you get them, and don't let those green trades go red. If you have a trade and you make 2% on it and it was a little day trade, awesome. You made 2%, lock that in. Don't let it go red if the technicals are telling you it's going to go red. A profit is better than a loss at the end of the day. So take your profits where you have them in a choppy market, and just be on par. If you can't focus on a trade and you're taking that trade, you shouldn't have taken that trade. Right now, I'm not taking a trade unless I can sit and look at that screen for the entire day and monitor that day trade. And I'm speaking of day trades when it comes to monitoring. I'm not taking a long unless the technical setup and the flows and every single box on my checklist is marked, because right now we're in that type of environment where you only want to take the best of the best setups, because that's the most likelihood of success. Those B setups, those C setups, those setups that are all right but not as good haven't been playing to the positive. They've been playing quite a darn bit to the negative, and that's something to note. So to round out, that's really my focus. That's where I'm at right now. I'm sitting on quite a bit of cash, and when the opportunity comes, when we get truly oversold conditions in the names that I like, and some of the bigger names, some of the leaders, if we do get them, I'll put cash to work. But until then, I'm sitting back, I'm observing, I'm being a student of the market, and I think that's how you have to operate at this moment. Patience is key.
Go ahead, Rick.
Fire, absolute fire. I got nothing to add. That was great, because I'm thinking the same way. So killed it.
Nice, thank you, Luca. Wandering Capitalist, did you have a question?
Yeah, I wanted to revisit some of the discussion around sentiment and understanding whether we've reached sort of a local minima. And I would say it's too early to tell. Bullard is speaking one way. We've yet to hear from Jay Powell. The minutes are from December, so we're kind of in this limbo land where it's really too early to know, where we are in the cycle. I would say if you want to look at technicals, one thing to watch is the percent of stocks that are above their 50-day moving average. In TradingView, it's easy. They have a ticker called, let's see, MMFI.
I'm sorry, I'm gonna have to remove Mr. Wondering. Again, I'm not trying to be rude, guys. I really want to focus on questions because we have a lot of them, not comments. I think we have many panelists, so I really want to help answer the questions that we keep getting influx of daily, and help out those that spend hours listening to us. So, Vishesh, did you have a question? I think you tried speaking, and I kind of called you back up because you requested earlier. What's going on, Vishesh? Vishesh, are you there? I guess not. Trend Wizzo.
How are you guys structuring or organizing or having factors into the analysis for your portfolio positioning?
Question was pretty low. I couldn't really hear it. Was your question, what do we look at before buying a stock?
Positioning your portfolio, how are you positioning your portfolio overall from a portfolio construction perspective at this moment, from a factor perspective? What kind of factor analysis are you pouring in, or what are the factors that you're
Yeah,
looking to?
I think the biggest thing I've been looking at is companies' free cash flow, their revenue multiples, and their future projections that the market has to naturally discount. We see a compression in multiples because of rising rates. So I did some selling, like I said, a couple of months. I've been kind of selling here and there. I definitely wasn't expecting what Powell did in November. I think that caught a lot of people off guard. So I'm not going to say I was perfectly positioned for that by any means. But every company I own, it's a company I believe in for quite some time. So there's not much change in my thesis on the companies. So the way I'm positioning is I'm just
Doing
sticking
more
to
of a
the most convicted names.
Got it. So more of a bottoms up than a top down approach.
Exactly. Yeah. I mean, I definitely have trimmed. Like, I'll give you an example. Like, DocN is a company I got out of, and I reallocated that money into SC, for example. Right. That's a company I have more conviction in. It dropped down significantly. So things of that nature. I'm just trying to focus on keeping my money in the positions that I want to keep for the longest period of time. And let me tell you this. One of the first questions that I want to ask myself before I enter a stock is, if this stock goes down 30% tomorrow, am I adding more or not? That's one of the first questions I'm asking. And if the answer to that is no, why the hell would you buy it? Like, I just don't see, like, what are you thinking then? You're clearly not convicted enough. So I've written a thread on this actually in depth on just the concept of building conviction. So I'm happy to share it if people want to see it. But yeah. Jay, what's going on? I see you just joined.
Hey, how are you? I was stuck on a work-related call.
All good. Did you I'd love to ask you this. First of all, are you an iPhone or Android?
Actually bought an iPhone last night. Very interesting experience at Verizon. They were completely out of iPhones, of every single iPhone except for the 13 mini. So kind of speaks to supply chain semiconductor issues. They said they wouldn't have another, larger phone for like 4 or 5 weeks, and the newest one they wouldn't have for like 6 to 8 weeks, which I've never heard of before.
And that's given a big market opportunity for pre-owned phones.
Insane. Yeah, actually, I shared this thread that I was talking about as well. It's pinned above. But Jay, what I wanted to ask you was, we've been speaking for a couple hours now. Bullard's, I guess, contradictory remarks to what came out yesterday, and the action we saw today. What's your take on everything? And also hedge funds selling record pace of tech stocks in the past 10 years today. I don't know if you saw the headline.
Yeah, absolutely. Both, with hedge funds, they were the ones kind of hedging November, December. I mean, think about it, right? Hedge funds have always been the marginal trader in the market. You could have Fidelity with hundreds of billions of dollars, right? You could have the Magellan Fund, with $50+ billion. But a small hedge fund with $2 billion of equity capital, levered 10 times long short, can affect the market much more in the short term than a long-term allocator. And one quick example is Citadel. Back in 2015, you probably remember, the financial sector. Names in the financial sector, the most boring sector, were down 5, 6, 7, 10% within a 2-day period. People were wondering why. Well, one of the pods within Citadel still is 11 times levered, 25 billion equity capital, 200+ billion of buying power, 1/10 of the fund, one of the pods, Ken said you're all fired, and they had to liquidate within a week. And it just shows you that these funds also have higher turnovers. It's not only do they have the buying power, they have very high turnover. So they might turn over 4 or 5 times a year, whereas a mutual fund may turn over 0.5 to 1.5 times per year. So before Schwab went to free commission trading in October 2019, hedge funds were the marginal buyer in the market. And the correlation was high because they would get into very similar trades. They've average daily trading volume limits, so they can only, they couldn't get involved in smaller cap companies. So there's a lot of the same names being traded. And then just increased after 2019, retail got involved, and you see every single type of name, micro caps, OTCs, small caps, mid caps, everything starts trading, and dispersion increases. And, retail trading went from, 17, 18% of volume to at the peak, like 35% of volume. So, but the issue is with individual investors is that they don't have the staying power to hold the name often for 2, 3, 4, 5 years. People get scared, they capitulate, they have things to use their capital for. They're at home, buying a car, had a child, have to pay student loans. So that capital is a little bit less sticky. And for that reason, if you see hedge funds starting to short names that they think are overvalued to hedge their book, right? Those names can go down pretty dramatically because there's no new incremental buyer. You're selling, retail's getting scared. They don't have dry powder to buy more. They're just, there's no one on the other side. And for that reason, there actually wasn't a lot of selling, for example, in November, December. If you look at fund outflows, you look at what was actually going on under the market, you look at institutional guys that weren't really selling. It was hedge funds that were shorting shares that were, you were seeing these sharp moves down. And that, I think, will continue into March in certain sectors as funds, that are caught off sides continue to hedge. I mean, there are a lot of Tiger Cub type funds, levered long tech. By the way, tech SaaS companies are, some of the best companies in the world. Just, these guys are just caught off sides temporarily. 2 years from now, these names could be much higher, right? But we're in an environment where, this selling, is hedging until some of these funds are levered and they need to hedge. They can't afford to be down 10% a name when they're levered, 2, 3, 10 times. So it's just something to consider. And then every time we have, the Fed has a self-correcting mechanism, right? So if you think about it, there are hawks and doves. Today, most of the Fed is actually dovish. There are uber doves, and then there are, kind of more hawkish doves. And Bullard, I think, you saw Kashkari's blog. He posted, I think I posted on my Twitter. For the first time, I think, one could challenge this, but I think Kashkari is the most dovish member of the Fed. And, he started questioning himself and, still thinks that inflation is transitory. I personally think inflation is transitory. It's just how transitory is it, right? Could it last another 3-6 months because of the effects of Omicron, the zero COVID policy, tying up supply chains in East Asia? And, he's saying, well, there's more of a risk that inflation could last longer, so I'm revising potentially my stance. Was it just, it's still read kind of dovish, but the gist of the blog, if you look at everything else he said in the past, was incrementally more hawkish. And that combined with the strong GDP number and the minutes talking about QT, move the consensus hedge, sell side, which are the banks, the consensus for quantitative tightening we talked about yesterday moved from Q4 to Q2, late Q2, June, July. And today, I think there's some backtracking for Bullard, but I don't think it really changed the picture at all. If it did, you would see it in the market because everyone was reading through that like a hawk, no pun intended. So, I think you're going to have other Fed governors probably speak. I'd be interested to see what others say. If maybe 3 or 4 try to backtrack, it could lead to some sort of relief in the market. But for now, I think the Fed has been politicized and they're stuck in a place where Congress is essentially blaming them for supply chain issues that were not the Fed's fault in the first place. And, obviously monetary policy raised asset prices and resulted in, part of this inflation that is temporary, but supply chain is completely out of the Fed's control. And, in order to control fiscal spending, Republicans in both the Senate, and I'm not biased, when it comes to any party, but it's really the Republican senators and, congressmen overall that were really badgering Powell, and Powell caved in November. And, Biden also pushed Powell and said, hey, I'm getting all this pushback about this thing called inflation. I didn't think I needed to worry about this, but apparently poor people have to pay more for goods and foods and clothing and travel and services, and small businesses have to pay higher wages and rents are going up. So we have to do something about this. And they might be acting at the exact wrong time. Maybe that's why the back end of the curve, was flattening through the fourth quarter, essentially forecasting slower growth. But you saw kind of a parallel to the yield curve, surprisingly, after Omicron started spreading in the US, because I think guys like Kashkari and other economic forecasters, by the way, who are not right most of the time, started to think, okay, well, Omicron could result in more supply chain issues and inflation could last longer. So that's kind of my 2-minute, that's kind of my thought process. I think that volatility is going to continue through March. We should get a couple relief rallies. I think earnings season is going to be the next upside catalyst. If there are names that have sold off, there are names that have sold off 30, 40, 50, 60, 70%. If, names in that group beat and raise earnings, you could have temporary rallies, or you could have follow through rallies depending on what happens in March. The important thing is not to be over levered. Conviction is one thing, but having a diversified portfolio of core names is a good thing to have. You don't want to miss a snapback rally, but you also don't want to be in complete garbage that can go down another 30, 40, 50%. So I'll take a break there and see if there are any questions on that.
Definitely. I think Jay Lynn wanted to chime in. I just saw Futures tweeted it. It's very early, but they're pretty green right now, pinned above. I would love a green close after this week.
Yeah, Jay, you actually brought up a really interesting point that, kind of sparked something I was thinking about. So you mentioned how hedge funds didn't really partake in much selling in November and December, and were mostly holding the majority of their long positions into this year. And then we saw this rampant selling of hedge funds that we've, historically have never seen, leading up to the past couple of days. I got to ask you, do you think this is, I know that hedge funds sometimes will take
Also,
some
the media headlines are just to answer part of, it's not even an answer, but, the media headlines are just wrong. Okay, yeah, in the dollar amount, hedge fund selling was the most that we've seen in tech. But as, think about it, the market has also quintupled, right, since this data has been being collected, since the data was collected, and the tech is also a much bigger part of the market. So as a percentage, right, the selling isn't really as bad as the media is making it look like. Like in 2018, like Amazon and the taper tantrum Amazon sold off 40%, right? We haven't seen any type of selling like that, but yes, the dollar amount of selling is alarming. Go on.
Yeah, I definitely agree with that. It's all relative, right? Like price action is going to change, especially as inflation, even stock prices get elevated. But I was just sort of going off this notion that you think it's a potential narrative that these hedge funds are taking some realized gains from last year, to, potentially fund some of their tax paying that's going to be coming up in the next couple months.
I don't have that type of knowledge or granularity on the tax that they have to pay. What I do know is that some of these guys were caught off sides, and people were expecting, January to rally. They covered their hedges, at the end of the year. They were heavily hedging November, December. They covered, they all got paid. And January is usually when you allocate capital. And all of a sudden, they're caught off sides. And it was even before the Fed. They're caught off sides with Omicron. They're caught off sides with Kashkari's commentary the day before the Fed. They're caught off sides with ADP. And then they're caught off sides with the Fed minutes. And the yield curve shift was, the sharpest yield curve shift we had seen in months, right? So all of a sudden, these guys had settled down and thought, okay, January is going to be decent. And, they started to hedge. Whether that's going to be, going to get worse, nobody knows. But could the brunt of it be over? I also don't know that. But a lot of it is, I don't think it's tax driven selling. I think it's hedging because they're running levered books, and they have some of these drawdowns. There are hedge funds that were, that had 20% allocations to names like SE, and this is all public. Imagine, you have a name that's down, 30, 40% that you thought was a bulletproof company, right? That's reported good earnings, every single quarter for the past 2 years, and that name is down. You have to sell something or hedge something, right? You can't just tell your LPs that, you took this drawdown and you didn't change your positioning at all.
Yeah, appreciate the insight here. Definitely agree with the fact that, a lot of these hedge funds have found themselves over levered. And that's going to be, something we got to watch how they adjust naturally. And, hedge funds that allocate 10%, 20% leverage to their, overall portfolios, it's can definitely cause some skews in the market here. So,
Of course, trading a hobby. Did you have a question?
Hi, quick question. I think we all remember in 2018, the Fed was so aggressive. I think we had 3 or 4 Fed rate hikes. Now,
3, yeah.
So now we are expecting, I guess, 2 of the rate hikes this year. So
3, I think.
Oh, 3?
I think Goldman's at 3.
Oh, okay.
I think there are a couple of banks that might still be at 2, but I think most banks are at 3.
So does it make sense that probably we may not gain overall this year because of these Fed 3 rates, or at least 2 rates? We may end up seeing as it is, or maybe no gains, or maybe going lower.
I just pinned a thread comparing what happened in December 2021 versus 2018. It's pinned above because this was a very big topic in last month, comparing and contrasting off of 2018. I'd love to hear from Jay. My 2 cents will be, I think the macroeconomics are vastly different, to be completely honest. You had that time international risk, if you remember. I mean, since you're bringing it up, I'm sure you were following the issues we were having from a scale globally with China. You had Brexit happening. You also didn't have the same type of inflation pressure that you're seeing then versus now, right? I mean, some stats I'll just read to you right now. Jay talked about the used phones. This was last month, so this data is a little bit outdated, but not too outdated. Used car pricing is up over 25%, home prices 20% increase, oil up over 50%, food prices over 1%. That's a CPI print, which we've been seeing nonstop, right? And that's something that Fed is trying to combat. So I think what you're seeing now versus then, it's very hard to compare, to be completely honest. Besides the rate hikes being similar, which by the way were stopped or slowed down because what happened in the markets in 2018, that month, December, we fell 30%. The Fed had to backtrack 6 months later, and you saw 2019 rally, and we ripped into February 2020. We topped in February 2020. By the way, Nasdaq actually hit 10,000 for the first time. Most people probably don't remember, but that was huge. That was actually like a big thing for Nasdaq back then, which is not even too long ago. So that's the answer towards the December 2018 comparison. I think it's just 2 different times. It's very impossible to, and we had a different president too. Right? Everything was different. So while you want to use historical references, I think what we're dealing right now are unprecedented times, a global pandemic, inflation running hot, which you can argue is transitory or not. I'm not really too convinced on either side. I mean, I'm just going to let the economy decide that, and as well as a record liquidity being pumped in the past 2 years, right? I think M2 money supply, I mean, just looking at that, I mean, what is that, like 40-50% of global supply has been printed? So I don't know, Jay, what's your opinion on this?
Sure. So, I mean, history doesn't repeat itself, but it does rhyme. And I think in some ways we're at a worse time now than we were in 2018. I mean, the key thing in 2018 was that the taper tantrum happened after quantitative tightening. It didn't happen early on, with the first hint of tapering. It happened when monetary conditions actually tightened. You saw high yield weaken. You saw the debt markets, weaken as well. Leveraged loans at the top of the capital structure, first lien loans, mortgages for companies were down 5 to 7 points in a period of 6 weeks. Right now, bonds are trading well above par. Loans are all trading at par. There's no issue of liquidity. There's no issue in the credit markets. I mean, the capital markets are running as smoothly as they've ever run before. And you're seeing these types of volatility in smaller cap names because, listen, the Fed doesn't have to care about growth in small cap names. They care about three things: price stability or inflation, right? Unemployment, and their third hidden mandate, which is asset prices. And asset prices are still near all-time highs. So volatility can continue, and the only way the Fed can slow inflation, because it can't stop supply chain issues in the near term, is by slowing demand and slowing economic growth. And they will get to that point via, I think Mahesh has his hand up, by slowing the economy and raising costs. And it could actually make inflation worse in the short term before it gets better, as those costs of higher debt, cause disruption in the capital markets. Mahesh, go ahead.
Yeah, I definitely agree with all of your points there. And personally, I do agree with you that compared to 2018, the vulnerability this year is unique. And Rahul made a lot of good points as to why the historical relevance is different for a lot of macro reasons. But one of the things I was wondering about, and I guess this is a question for everyone, is I've been using a lot of different measures to see the downside risk, at least in the near term. And so I've been relying on like the ARMS index, looking at TRIN, looking at the tick, comparing the CPC ratios and all of that stuff. Is that something that you guys are looking at too, to manage your like exposure on a day-to-day basis, or is that something that's not as relevant on your radars because the short-term volatility is not as important?
I think everyone's different, so everyone can answer differently. I mean, I am aware of it. I don't really use it to manage day to day. I tend to be very individual, name focused. The title of special situations, I'm looking at names that have minimal downside, high upside, or on the short side have minimal upside, high downside, and some catalyst. So I manage my portfolio a little bit differently. But those are important indicators, and I'd love to hear what the other guys on the panel think.
I think I've spoken quite a lot to with Jalen or TSDR. You guys want to jump in? Or Luca?
Personally, I don't use either of those two indicators. Like I think someone mentioned it earlier, but one I kind of use for like a broader picture is the McLean oscillator. I think this gives it like a good perception of where the indices are standing at the point. It gives a good indication of what might be overbought, what might be oversold, and like just building upon that. RSI is a good one too. Personally, though, no, I have not used the ones you're talking about.
I mean, the way I think about companies, when I don't have an event catalyst or some catalyst when I'm doing a trade is, if I were to own the business, okay, what would that business be worth using 3 or 4 different types of valuation? Where could I sell that business to a private investor today? Is the business, defensible? Does it have recurring revenue? What is the competitive landscape? What is the supply chain? I know we're talking about supply chains now, but what do the vendor relationships look like? What do the customer relationships look like? Is there supplier power? All the traditional kind of Porter's five forces. Before I make an investment, I spend 2-3 weeks thinking about the business. I don't just jump in and trade because someone on FinTwit said this business is sexy or this business is terrible. Even if it's a short and the company has 0 earnings, I try to understand, okay, why does the company have 0 earnings? And over the next 3 years, is there a foreseeable bridge for that company to generate reasonable earnings or free cash flow? And if the answer is no, and or I think they're going to have to raise equity, there is a, if you don't do that, then you're gambling, right? If you're just looking at, the moving monkey and you're just looking at, moving averages and, relative strength, right? Like technicals are very important, right? Price, volume, volatility. Technicals work outside of that, all of the tools people use because of one reason, because other people use them. That's the only reason they work. So taking a step back, right? It's more important to think when markets are volatile, to think, if I were to own this business for 2-3 years, what do I think this business is going to look like over that time? How are revenues going to grow? How is the competition going to change? Are they going to have to sell a business, acquire? Are they going to have to merge? Is this business going to be disrupted? I think when people are looking at emerging sectors like renewables and EV, they don't understand how the competitive landscape is going to change and how much more difficult it is going to be. How Rivian is going to have like 5 competitors, and Tesla didn't have that when Tesla was starting out. So, again, like please feel free to use any type of sentiment or indicator that makes you feel comfortable about your decisions. But the most important thing is understanding the business that you own and why and what your risk tolerance is. If that business were to see its price down 20, 30, 40%, and fundamentals of that business didn't change.
Yeah, I think I literally pinned a tweet that summarizes kind of what Jay says. I'm pretty on par with that. It's pinned above. It's called before buying. So, Mahesh, if you want to check that out.
Yeah, I definitely agree with you guys. The bottom of approach is definitely something that I follow too. So thank you guys for
Oh,
that.
dude, just when we were like got 2.5 hours in, Luca's here. We have the legend. Stock talk. I can't end this without hearing from him.
Must hear from him.
Yeah,
Bring him
yeah.
up. Bring him up. Bring him up.
I am. Yeah, if it lets it connect. Is he here? Stock talk.
This is like 2-3 hour spaces in a row. Hello.
Dude, yesterday I ran 4.5 hours. Then today we had the
Bro,
morning
you have a
one.
lot of mileage. I think you've done like probably 10 hours of spaces in the last like, couple of days, right?
Just this week, I think probably 20 hours. Probably past 2 months, over 100 hours myself, to be honest.
You've had so much
You know,
content, dude.
your space was I think the first or second space. I did one with LeaderSpat. The only spaces I've done in the last 5 weeks because of this whole Samsung, this Android issue. I just couldn't do it until yesterday.
Yeah. No, I mean, MM has the same issues, or else we would have had Market Mayhem on with us every single time. I have to actually convince him to come on now because he hates getting booted. But I tell him that, once you're on, you'll get the mic as long as possible and you can just spit. So I hate losing him because you, MM, you guys have some great macro knowledge. It's awesome hearing from you guys. But Stock Talk, the OG, what's going on, brother?
Hey man, I'm chilling. I've been away from the markets for a few weeks. So today was I'm sure people noticed I was tweeting a lot today, but yeah, I mean I was on a vacation for pretty much since like December 15th. So I've been gone for a while, and I just got back to Dallas last
Was that the
night.
top? Was it the top Stock Talk left the
Yeah, I mean, it was a good time
market?
for me to take. It was a good time for me to take a break because, like, honestly, I was like high because I don't like being overexposed in my trading account when I can't be active. So, like, I had raised a lot of cash before I went on vacation, and so my trading account kind of like avoided the brunt of a lot of these drawdowns. My long term account didn't, but that's fine. That's part of the process. I'm used to my long term account swinging and being pretty volatile, so I'm fine with that. But yeah, I mean, it kind of was a good coincidence to like take a break for the last 3 weeks. And I mean, I've been tweeting a bit and I've been on Discord a bit, but I'm going to be a lot more active now. I'm kind of like charged up, ready to go. So
Two questions for you, Stock Talk. I mean, some of this might be repetitive, but I do want to get his opinion on a couple things. So, one question is something I saw on Twitter just an hour or two ago on DWAC or something happening with that. There's some headline. I know you traded fun as a sympathy. Is there something happening tomorrow? I guess that's question number one. Question number two is more macro driven. I guess Jay pointed out, and a lot of us, we've been on space pretty much for last 4 or 5 days, like 2, 3 hours a day, and the biggest question has always been like, how are you guys acting in this market? How are you taking in Fed information, et cetera, et cetera? Everyone's trying to figure out how to position size. And there was a tweet I wrote a tweet on a comment you had said, which I loved. I don't remember the exact verbatim, but you had said in times of volatility, you like to decrease the amount of holdings, increase your conviction, or you worded it in such a perfect sentence. Do you want to just kind of share your thoughts? Because I think everyone is having this challenge, us included, right? I mean, none of us are perfect, of just the volatility we're seeing. And what's your take? I'm sure people will love to hear on both those topics.
yeah, so the first one on DWAC, I don't think there's anything particularly happening tomorrow. They just announced the February 21 release of the application. Granted, this could be, one of those sell the news events coming into that February release of the app. For now, I mean, today it seemed like there was some enthusiasm going into close, but DWAC and Fund both kind of tapered those gains as we've like been in the after hours session. I'm not saying they won't peel up in pre-market tomorrow. There's a good chance of that. I'll probably be trading those early at like 3 a.m. and then not like worrying too much about what happens in the regular session. I might hold a little bit over. I remember last time we had this run up, there was like a big surge going into close for UAC and Fun, and then the next morning is when we saw that Fun run to 2,000% when at open, and then we saw DWAC run a few 100% as well. So that could happen again. But I mean, typically what happens is when you have these kind of trades that everybody knows about and everybody's slapping like clockwork when they see a catalyst, those kind of trades tend to get overcrowded and they work less and less well every single time. And I'm not saying that that's like a hard rule, but generally I've seen like when you see these sympathy trades or you see these catalyst driven trades that everyone knows about, it's hard to like say the more obvious a trade is, the less likely it's going to pan out the way you think it is. And the more obvious it is to more people, like, that makes it more and more or less and less likely to be like a guaranteed win, I guess you could say. But yeah, I don't know. I don't have too much of an opinion on the short-term price action in those names. I do know that I'm going to continue to play the pops. Like anytime there's news, even like some kind of news on Trump or Truth Social, these names tend to run and pop. And so if you take profits quickly, I mean, you could have caught a 20% move on Fun, and you could have caught a I don't even know how much. DWAC ran like 20% as well in the into the close. And so they're both kind of tapering those gains after hours, like I said. But if you trade these in and out quickly, you can make decent money doing that. I don't know if these names are going to hold the gains. Like I've been surprised personally that DWAC has even held up at this level for this long. Like that's astonished me. I thought it was going to have like when growth and SPACs and D-SPACs were selling off, I thought it was going to have a massive, huge drawdown in it, and we didn't see that. So there are clearly people that are buying and holding the stock and occupying a certain percentage of the flow, whatever that may be. But I expect those pops to continue when we have catalysts and updates about it. And then going into the release of the app in February and potentially the close of the deal, which I don't know when. There's no real context on when that's going to happen. I don't know if Jay had more insight on,
Yeah, I mean, just estimating based on how long I think proxy filing and all that stuff is going to take place. My estimate is that April, but that can change really quickly. I'm looking at when I look at SPAC filings, I'm looking at the 196 D-SPACs, and for each one, I'm going through and looking at the time it takes from DA to completion, and it's not an exact science, but for example, with ALAC, right? You file there's a preliminary filing on 12/30, and the fourth revision, 2020, the fourth revision just happened in mid-December. But for a company like VMAT, as Media Acquisition Corp, the preliminary filing was in October of 21, and the fourth revision happened in December of 21. So and the merger meeting is going to happen on January 19th. So what I do is go through hundreds of these and try to estimate when I think the deal could.
But at the end of the day, it's kind of arbitrary, right, Jay?
But it is completely arbitrary. So
there have been SPACs that have taken months and other SPACs that have taken weeks. So
100%. So my best estimate, is between late February and May. I'm thinking April, but it's really not set in stone, and anything can happen in the meantime.
The one interesting thing about this deal that I think is, I mean, at the start of December, we saw this. The first week of December, we saw, and these numbers are not concrete, so don't, take my word on it. These are just the reports that we saw from Reuters and Bloomberg first week of December. They said they were looking to raise up to $1 billion at a $3 billion valuation. And they wanted to price the pipe at a 20% discount to the 10-day VWAP. So, at that time, I think it was like 33 or 34 a share that they were looking to price the pipe at, which would make it the highest priced pipe that I've ever seen. I mean, I think for Lucid was the highest we've seen before this at 15. If they really are able to price this pipe at 33 or 34 bucks, I mean, that'll bode well or better for the stock price to hold up. But, when I look at this, I see a lot of similarities to Lucid, right? Like when we had the Lucid rumor drop, we had, that stock held up very well. And it seemed like every week it was trading higher and higher when Lucid was CCIV. And then once we got the DA and we had a concrete number on the valuation, you kind of got that valuation shock, which was in February. And then we saw Lucid obviously tank from like 65 down to the 30s very quickly and, proceed to go lower and lower over the course of the next few months. It had bottomed out at 15 or 16 before it started rebounding again. So, there's always a risk of that sell the news event once the deal is procured and once we have more like definitive details on the valuation and what, the revenue projections and stuff on a deal like this. Like anyone who read the DWAC investors presentation is one of the most like dog shit investors presentations I've ever read. There was like no detail, just like random like comparisons to these like massive tech conglomerate companies saying like, oh, we're going to compete with Twitter, YouTube, Facebook. Like, yeah, theoretically you will. And, I don't think that I think from a tradability perspective, I don't think the viability of Truth Social as a competitive product is really the question here. The question is like, how tradable is it and for how long? Because like, if you want to own it, if you want to own, stock in Truth Social or whatever it ends up being named, I think that's what it'll be called. But if you want to own stock in that company, that's fine. And that's your personal decision. And if you're like super bullish on the growth of that company, so be it. But if you're a trader and you're just looking to profit from this run up, like I'm not going to be holding DWAC into the merger, or likely even into like, any significant or material updates on what the specific deal is going to be or the valuation is going to be, because I think there's a huge chance of valuation shock. Like if there is, if it's forward at a $3 billion valuation at $10 and it's trading at 60 plus, I mean, that's a fat valuation for a company that has no revenue, no real, market approach, no competitive approach. I think it's going to be difficult for that to retain share price. But obviously,
And
like they
stock
said,
top, it's
yeah.
not only that. I mean, think about the structure, right? You have the TMTG shares, you have the earnout, you have the DWAC shares, the DWAC promote. So the total diluted shares I remember on DWAC were 178.5 million, right? So at today's share price, right, you're at like almost a $10 billion valuation, right, for a company with no, it's going to be 3 to 5 years before they have meaningful revenue, right? So to have a third of the valuation of Twitter right now, where Twitter is generating a couple billion in EBITDA and multiple billions in revenue. I think people might be surprised. This could be down 50% plus when the app is up and running.
Yeah, I completely agree. I don't think that there's, if I were to just make a guess, I would say that the stock trades down significantly post merger. But yeah, I mean, that's just my general perspective on. I'll continue to trade it, and I'll continue to trade the sympathies as well. CFVI even got a little pop at the end of the day today, and there's like more and more sympathies emerging. Mark has kind of been touted as a sympathy. There's like a tiny dollar stock that I don't really know the connection there, but that's been running as a sympathy as well. Benny was running as a sympathy, obviously, before all these problems that the SPAC deal has been having in the last few days. So that one's kind of out of the picture. But I'll continue to trade these names and the sympathies on the pops. I'm not looking to be too greedy. Like, I'll take those. Like I caught that fun move like part of the way up and sold a bunch. It peaked at plus 20%. I held a little bit. I'm going to hold a little bit into tomorrow just to see if we get that pre-market pop that we got last time. But because it's put out in February 21st, I mean, there's a lot of time between here and there, and that's like, traders especially aren't going to be that patient and hold this stock for a month. So, that's just my general outlook on it. But we'll see as the deal develops. Who knows what the pipe structure will end up being or what the pipe price will end up being. So, I think that'll definitely matter going forward. But yeah, I mean, that's just my thoughts on DWAC in a nutshell. And what was your second question, Raul? Something about macroeconomics?
Very quickly, one thing I'm disappointed in myself about, we were talking about this in the Discord, is it's January 6th. Knowing Trump, I should have known there was going to be a PR that came out today on the day of the.
It's a good point. I didn't even think about that. January 6th.
I didn't even realize that until you just brought that up.
Oh man, I've been thinking about it for the past couple of days. I was like, I wonder if DWAC does anything. I've had, because I know Trump was gonna have a not a rally, but give like a speech or put out a video or whatever he does now. And I figured DWAC could have a potential to run on that, and I just got just distracted and forgot about it. So I'm kind of mad about that.
Good point, TSDR. Good point. Yeah, I guess my second question was more macroeconomically, which we spent the past few days covering for hours, but I think I'm sure the audience would like to hear from you as well in terms of, like I said, I think in the past you said, around these volatile times, you're reducing the amount of positions and just making sure your conviction is increased in whatever you hold. But any comments on kind of, the past couple of days, what we've seen from the Fed? Obviously, yesterday came out a lot more hawkish. Today, you saw a little bit of a backtracking. Just overall, I'm sure people here that follow you would love to hear just your thought process on how you're approaching the next, I think, few weeks, because we have more volatile events coming up as well.
Yeah, I mean, I think it's just kind of like, the reality of the change in monetary policy is kind of hitting the market a little bit. Coming into this year, the number of rate increases was being kind of debated, whether we'd get 1 or 2 or 3 this year. And now it's looking like we'll potentially get 3 this year and then a 4th in early 2023. And granted, the absolute rates aren't going to be like, it's not like interest rates are going to be quote unquote high immediately. They're going to gradually increase interest rates. That's what they've done in the past too. And that's what they'll do this time. But I think tapering ending maybe a month or two sooner than people anticipated, and then that flip to the interest rate hikes happening a month or two sooner than people anticipated might have contributed to some of the selling. But I also think like there's not a lot of tailwinds for the market, especially considering where we are. We were at all-time highs at the end of last year, and we're coming into this year, and the indexes, like, despite the fact that so many playing in SPACs and de-SPACs and small caps, That's just the way FinTwit is, and most people are in those names. The drawdown in those names has been a lot more steep than the drawdowns in the indexes. And so, when you view it that way, people have like a misconception of how bad the market has been, right? Like if you were just long on the S&P last year, you did very well. If you were just like a passive investor and you're long in the S&P, you did very well. People who were stock picking individual names saw way, way bigger drawdowns. I mean, I think there was a statistic yesterday, like 20% of all stocks in the NASDAQ are down 50% or more from their highs, which is crazy. But, they can definitely go lower. If you look at the RSIs on some of these names, I mean, they're still, trading at 30 to 40 RSIs, which is, technically oversold, but those RSIs can still go lower and those stocks can still go lower. A lot of them have forfeited key supports. For people who look at charts every weekend like I do, like the charts look shitty on a lot of names, whereas they looked decent a couple weeks ago. And so, that's what happens when these stocks forfeit key supports, forfeit historical supports, forfeit places where institutions were previously willing to be buyers and aren't now. And so, the change in the time value of money, which is really what interest rates dictate, is going to really impact and we've been talking about this, I've been talking about this, Jay's been talking about this pretty much all of last year. Change in monetary policy is going to immediately affect higher growth tech names that are more dependent on future cash flows, because when interest rates go up in the immediate term, then that discounts those future cash flows. And that's really the simplest way to look at it. I mean, you can get more detailed, but for newer traders, that's the simplest way to look at it. Rising interest rates increase the time value of money, which discounts those future cash flows. And so you're going to see that effect happen. The beautiful thing about the market is, though, if you do see a drawdown in growth in tech 3-4 months, eventually there's that capitulation and that recognition of certain names that are going away from being considered high multiple growth names. They draw down 50, 60, 70%, and then they start showing some semblance of value and they start becoming better and better buys. And once that happens with enough of those names, then you might see more liquidity come from institutions and big buyers into these sectors, and then that might cause some reversals and some bounces. I don't know when that's going to happen. That's if we could all predict like these massive drawdowns in growth and when the rebounds are going to happen, we'd all be billionaires and we wouldn't be here talking about this. But knowing that you can't predict it, the best thing you can do is be prepared. Like I've been accumulating FAS. I added some more today. That did really well. I want to get more exposure to financials as we go into these interest rate increases. I think it might be an obvious play, which might scare people away from it. But, in reality, the institutions and the big money are going to be putting liquidity there because banks are going to benefit from the rise in interest rates. And so, I'm increasing exposure to FAS there. And like you said earlier, in these kind of markets where they're unpredictable and, I don't see a ton of tailwinds for the market, but I also think that a lot of the headwinds are baked in. Kind of puts you in a predicament where you don't know which direction we're going to go. And in those kind of situations, I try to lean on higher conviction positions with bigger size as opposed to having a dartboard of positions. Like in 2020 on the rebound out of the crash, I was taking a lot of positions, kind of just throwing darts at a wall because it was working. And you saw rebounds, massive rebounds and quick rebounds in a number of names. Growth and tech obviously outperformed going into 2020 and going into the start of 2021. And then throughout 2021, you kind of saw that rotation away from a lot of these high multiple names and into more cyclical names or more stable names or even financials. And so I expect that rotation to continue to some degree, but I also do think that, at a certain point, the selling will stop in growth and tech and small caps. And when it does, I think you'll get a very aggressive rebound. And that's the beauty of the market is whenever you see these drawdowns or corrections, they're bought up very quickly, generally. When you're thinking about it in a long-term point of view, I think on FinTwit, a lot of new traders get like really myopic about like how long these effects are actually lasting. A few months in the scheme of the market is not a lot of time, right? Like a few months, if tech and growth draw down for 2 or 3 months, that might blow up a lot of people's accounts, but in the grand scheme of things, it's not a lot of time. And so I think over the course of the next few years or even the next decade, if you want to pull out your time horizon that far, I think growth and tech will be fine. I just think in the immediate term, with the interest rate fear, with the change in monetary policy, with the reduction in quantitative easing, and the Fed kind of shifting to a less accommodative stance overall, it's not obviously not a good thing for these names. But the quicker and quicker these reactions become, and the earlier and earlier these reactions become, I think the better it is, because then we have more and more likelihood of, once the actual event happens, that kind of sigh of relief rally that you get from the market, which happens very often, where people are like, all right, now we're finally, we're out of QE, we're in the interest rate increases. We might have seen a drawdown for the last 5 months in growth and tech. And then you might see buyers step in and say, you know what? The absolute interest rate isn't that much higher. The absolute interest rates aren't going to be comparatively higher to the past for a while, right? At least for a year plus. So knowing that, and knowing that the relative interest rates are still going to be relatively low, I think that could bake us for a rally, middle of this year, end of this year. But obviously, again, I mean, I can't, that's just speculation and a prediction. But yeah, that's just my general view on it. And yeah, again, I am reducing. Like, I went from, I would say in 2020, I was running probably about 10 to 15 positions at a time, and now I'm running about 5 to 7 positions at a time, and prioritizing cash a lot more, because I want to have cash available, not only to add my high conviction longs when they're down, but also to play puts and shorts when I need to, when I feel like the market's um, trending downward. And so I want to have that optionality to play both sides of the ball, and also to add names that I'm really convicted on. But yeah, again, I've reduced my positions significantly, and that didn't start now. That wasn't like a 2022 decision. I started doing that middle of last year. And I was talking about it on Spaces for a while last year as well. Just like, the reality is most people on FinTwit just trade the same way all the time. And that can work for you from a strategy perspective, but not if you're not nimble with regard to what kind of exposures you're taking, being aware of the macroeconomic impacts on different asset classes, and knowing that, like, hey, if monetary policy changes, it's going to affect the high multiple stocks first, and with regard to NFTs and, things like that. And people are like, oh, NFTs are going to be immune to this downtrend in the market. I really don't believe that at all. I think that the NFTs, just like any other asset, are really like a speculative place to put your money, and they work really well when money is free and abundant and liquidity is great.
You could have a zero bid. You could have an NFT go from 5K to literally zero, right?
Yeah,
if you
exactly.
don't have a bid for it.
Exactly. And that's not me being bearish on NFTs. I'm just saying, in general, speculative assets in general are going to suffer, and it's a matter of how long they'll suffer for, and when the suffering will begin, and when it'll end, right? That's the crux, and that's like the thing that's hard to predict. Like, will it be baked in? How long will it take to be baked in? When will the reaction start? When will the reaction end? Will the initial rise of interest rates be a sell the news event or a buy the news event? Like, these are all questions that we can ask ourselves, and like, we can make speculative predictions on them, but there's no concrete answer. If we knew, then I would just over leverage on every time, if I knew for sure, if I had a crystal ball. But I'm just playing it safe. I'm continuing to play it safe, continuing to keep on my trading account. I'm continuing to keep between 30 to 60% cash, depending on the week. Continuing to try to take profits quickly, not overhold. When I see those 15-20% gains that I normally might be like, hey, I'll let it run a little bit more, I'm just snagging those, taking them, getting out, rotating. So I'm trying to be nimble. Doesn't always work. There are days like yesterday, I was red on both accounts. I was red on my long-term account and my short-term account. Today I was green on both accounts. So it's going to change, and it's about being adaptive and being nimble and being aware. And also, if you're a long-term investor and you're not just a trader, which I know a lot of what we said is relevant to traders, but if you're a long-term investor, you need to be hedged. And for those of you who don't know how to hedge, I recommend you explore doing that, because if you just hold your long-term portfolio as a watcher, I tweeted this yesterday as well, like, don't be a bystander with your own money. So many people that DM me and comment on my posts constantly are like, holding this same basket of 10 stocks for the last 2 years, and they skyrocket and I don't take profits, and they dump, and then they skyrocket again and I don't take profits, and they dump again. And these people are just putting themselves through unnecessary stress. Like, manage your positions, like, manage them. But by that I mean actively. If you're trading every day and you're not doing anything, if you just wake up every day and you just stare at your portfolio and you're like, oh, it's up today, oh, it's down today, oh, it's up today, oh, it's down today, like, you're not accomplishing anything, and you're not going to retain your gains. That's not how the market works. You might be able to retain, small caps or growth or whatever. People who got spoiled in 2020, they're like, oh yeah, well, all my stuff held up in 2020. Yeah, well, in 2020 there was a ton of accommodative policy and a ton of liquidity and a ton of free money. Of course things held up then, right? And now that's not the case. And So yeah, bottom line is the question becomes is how long will the sell-off last? Is it going to be baked in? How long will it take to be baked in? And what's the immediate reaction going to be once we finally do get that first interest rate rise? So that's kind of what I'm watching.
Appreciate that, Stock.
For
Thanks for
everyone who
sharing that.
has any type of, whether it's Google Finance, Yahoo Finance, if you want to just pull it up and look at, I know we don't all have access to leveraged loan indices because some of them are licensed by banks, but if you pull up the Invesco Senior Loan ETF and you look at what financial stress actually looks like, and you look at what a taper tantrum looks like, you go back to 2018, and again, history doesn't repeat, but it rhymes. There's no financial stress in the system right now. We have not actually had a taper tantrum. People think we had a taper tantrum, but what we saw, a bunch of micro caps sell off and some small caps and some pandemic names that rallied, 300-400%, giving back half their gains. That's not a taper tantrum. So, who knows what it will actually be? Who knows how long it will last? Who knows if actually when they do raise rates the first time the market rallies, and then the second or third time it peters out? No one knows, but I am confident in one thing, in that you can describe what we've had so far as a taper.
Eric, I know you had your hand up for a while. Did you have anything to add in?
I just thought that was awesome. But I think this is my first time being on a spaces with Stock Talk. Is that right?
Stock Talk Weekly, Special Situations, These are probably some of the smartest on here.
Oh my God. Talk about I feel like rookie class hour, but yeah, crushed it. That was awesome.
Nice. No, of course, man. It's great to have these guys on. Unfortunately, I just see.
I do remember my question now.
Go ahead.
It took me a minute. Now I remember. Stock Talk, are you looking for bases? I feel like no one on Twitter is looking for a base. And I just know you kind of mentioned, hey, I'm looking for, these to rebound and snap back like a rubber band. And I'm more thinking of, what we'll start seeing more of a fight between the Bulls and the Bears and start basing. But that's not a popular opinion right now. Just wanted your thoughts, because there's someone finally who's like, yeah, we'll get a snapback. But it'll be, that was just a differing point than what I've been thinking we'll see. So just interested on that. But Raul, I know we've been going for a while, so I hope my question doesn't turn into more hours of questions with you.
No, I see a bunch of requests, and I'm going to apologize in advance. It's been too long. My phone's dying. I haven't moved around too much. I have to get to other things. But I'll let Stock Talk chime in before we close here.
Yeah, I'm not saying, we're going to see an elastic bounce right away. I just think at a certain juncture we will. The issue with looking for basing in a market like this is that there's a lot of stocks that have fallen to, key supports from a long time ago, whether it's like a year ago or 6-8 months ago. And those may look attractive, and they may look like they're basing out. But the reality is, if we keep seeing these broad, indiscriminate selling events, which is what we're seeing, like the NASDAQ will drop 2%, and then a bunch of these small cap and D-SPAC names will drop 10-15%, right? If you keep seeing that, those stocks are going to forfeit those bases and forfeit those supports. So what I'm more so looking for in a market like this, if I'm looking to play bounces, let's say on a green day for the NASDAQ, if I'm looking to play a bounce, I'm looking for relative strength on the red days. So I'm looking for, whether it's small caps or D-SPACs or any kind of stock, even large cap tech stocks, I'm looking for the stocks that hold up well while the other ones are dumping on bad days. And those are the stocks that I look to go long on a green day, because those are the stocks that are going to have, relative strength is important because it shows you that whereas there's sellers indiscriminately in all of these other names at a certain juncture, they aren't willing to dump that name as aggressively. And that generally bodes well for a rebound on a green day or a reversal on a green day. And so I'm looking more so towards relative strength than I am towards stocks that are basing out or hitting supports for that reason. But if you're looking, to assess relative strength, I do it via a master watch list. So I have like a huge watch list with hundreds of stocks on it, organized by different sectors. And then when I see these massive drop-offs in a particular sector or a particular asset class, I'll pull up my watch list, I'll organize by percentage gain, percentage loss, and I'll just study them for a week or 2 weeks or however long it is. And I'll see like, okay, hey, this stock in the last 6, red days of the NASDAQ, this stock has only fallen, let's say 4%, whereas peers have fallen, I don't know, let's say 20, or I'm just throwing numbers out there. Let's say peers have fallen 20, 25%. That's a good sign that stock has relative strength and that it's more likely to rebound or reverse on a green day. So I'm a relative strength hunter in a market like this, as opposed to like a support hunter. Not that I'm not looking at the charts, because
Yeah.
if you're seeing relative strength, you still want it to be sitting at a key support. But yeah, I find to look at relative strength in a market like this than looking at necessarily stocks that look like they're basing out. Because let's be realistic, there have been stocks over the last couple months that people are screaming, hey, this is basing out, this is a long-term historical support. There were institutional buyers here in 2018, 2019, 2020. Like, there's so much support here, and then 2 weeks later the stock is down 15% from that level. So, I'm not saying it's a bad thing to look for stocks that are basing out or hitting key supports, but pair that with relative strength, and that should, I think, serve you better.
Yeah, thanks, man. I appreciate that. I just it was just interesting hearing that like different, philosophy. So appreciate that. RS, I mean, it's one of those where when you see it, you know it. All right.
Appreciate it. No, thank you, everyone, for tuning in. I see we have a slew of questions. I'm gonna have to apologize. We've been going on for 3+ hours now, so I just want to kind of call it. Again, I know you guys. I guess some people questioning me and saying, why are you guys running these unplanned? I need to know this, and I apologize. Nothing I can do. I mean, the only thing I would suggest is obviously follow the speakers and the handle of Pounding the Table. You'll get notifications when we're on. Some of these are planned. There's one planned for next week, January 12th, a cybersecurity related space. We had one today with Feraldi that was planned and well marketed ahead of time. But the ones we run intraday or like this that last for hours with Q&As, really just to give back and help, right? I always feel bad ending these when I see so many questions still pending, but it's just only so much time the day and you can commit to this. But again, give everyone a follow for sure. Some of the best folks on here: Stock Talk Weekly, Special Situations, Running with the Money, Luke, TSDR, Jeremy Lin, Eric, who was just on here, a great guy, Pounding the Table, of course. And these are some of the smartest people on here. I love interacting with all you guys, and thanks for joining in and kind of contributing your thoughts. Really appreciate it.
Hey, thanks for having us, man.
Thanks a lot, Raul.
All right, Happy New Year. Happy New Year. Good night.
if you're seeing relative strength, you still want it to be sitting at a key support. But yeah, I find to look at relative strength in a market like this than looking at necessarily stocks that look like they're basing out. Because let's be realistic, there have been stocks over the last couple months that people are screaming, hey, this is basing out, this is a long-term historical support. There were institutional buyers here in 2018, 2019, 2020. Like, there's so much support here, and then 2 weeks later the stock is down 15% from that level. So, I'm not saying it's a bad thing to look for stocks that are basing out or hitting key supports, but pair that with relative strength, and that should, I think, serve you better.
Yeah, thanks, man. I appreciate that. I just it was just interesting hearing that, like, different philosophy. So appreciate that. RS, I mean, it's one of those where when you see it, you know it. All right.
Appreciate it. No, thank you everyone for tuning in. I see we have a slew of questions. I'm gonna have to apologize. We've been going on for 3+ hours now, so I just want to kind of call it. Again, I know you guys. I guess some people questioning me and saying, why are you guys running these unplanned? I need to know this, and I apologize. Nothing I can do. I mean, the only thing I would suggest is obviously follow the speakers and the handle of Pounding the Table. You'll get notifications when we're on. Some of these are planned. There's one planned for next week, January 12th, a cybersecurity related space. We had one today with for Aldi that was planned and well marketed ahead of time. But the ones we run intraday or like this that last for hours with Q&As, really just to give back and help, right? I always feel bad ending these when I see so many questions still pending, but it's just only so much time the day and you can commit to this. But again, give everyone a follow for sure. Some of the best folks on here: Stock Talk Weekly, Special Situations, Running with the Money, Luke, TSDR, Jeremy Lin, Eric, who was just on here, a great guy, Pounding the Table, of course. And these are some of the smartest people on here. I love interacting with all you guys, and thanks for joining in and kind of contributing your thoughts. Really appreciate it.
Hey, thanks for having us, man.
Thanks a lot, Raul.
All right, Happy New Year. Good night.
Y'all on level 1, I'm level 3. Pounding on the table for my team. Every night I flex, I'm making big moves. That's a big move. Big money,